This first lesson is gonna be on market mechanics and how exactly I view price. It is an introduction, but it's extremely important because if you understand this, everything else is clear and has its place in some way. First of all, I think that the people, I don't know why they don't know, but there are different markets. So, for example, there are two types of markets. General trending markets like stocks or indices or also commodities in some months of the year. And there are mean reverting market, ranging markets. Currency, Forex, is the main example of a mean reverting market. Why? And this is an important topic. So, if you look at, for example, euro dollar, but every currency, USD CAD is now on an important range. Currency gyrates around. There are no real supply and demand for currency, no? The world doesn't need to buy currency like it does with gold, with copper, with the S&P 500. So every movement, it has to be engineered. By who? Smart money. But they can't move currency like straight up or straight down. I take the Forex market as an example, but think. They can't do that because the entire global economics will collapse. They need to be smart and keep the value of a currency at the same price level. So CAD, if you look in the past, 2 years, it has, moves, but look at the price on the right, 1.39, 1.32. The movement isn't a lot, and so it doesn't affect real world economics too much. They use this to make money because why the markets are being created and why they're still in place? To make money. Smart money makes money on speculation, and obviously they need the counterpart for their operation. So, not us, we are little fish in the markets, but hedge fund, pension fund, or treasury funds, they are all institutional money, so big pockets, but the process, the behavior on the market is the same. They want to invest or speculate, and so they enter on a retail basis, if you know, a big retail. But the people that really control and moves the market use them as counterpart. So if you think about that, the most controlled markets, Forex, is the easiest one to trade if you really know how to trade it. Because every market moves, and this is what Romeo said, ICT said, on the basis of time and price. So if you understand the ranges are the key to the markets, and the behavior of price in regards to the time of the range, you can read it pretty accurately. So we take an example, DXY. Right now, DXY is on a clear uptrend with the objective, if we focus ourselves on the last 60 days windows. Oh, sorry. From now, the 60 days, yeah, so the 60 days high is this one. So the target that I have in mind is this, and we can see that we stopped, we're coming off of this breaker, and after that we created this high probability order block with the closure above the wick of the candle until breakout. Right now we are retesting the body where the major portion of the candle volume resides, while tapping into this weekly FVG. So not financial advice, but I just give you the bias, what I think it will happen. The invalidation will be if we close on a weekly basis under this weekly FVG. So this gives me a framework, because many people see Romeo, and this is important, I want you to succeed as well. So many people see Romeo as the Holy Grail, and it is a great trader, a great teacher, a little bit cryptic, is mysterious in the way he speaks, but the knowledge that he has is amazing. So many people overlooked the classic analysis. So you need to go from the higher time frame perspective. You need to understand, first of all, the market you are trading, because Nasdaq right now it's in a crazy uptrend. So why you would sell this turtle soup? It's not a turtle soup, it's a true breakout PDRA at the range high and rally. I'm not touching on time yet. I want you to know that. For the next lesson I have a lot to say. I just giving you the basics so you understand how I view price. So you need to understand the state of the market you are trading, what market you are trading, and act. This is real trading, and act based on that. So coming back to the XY, it's in an uptrend, and right now the intermediate to long-term bias is bullish. Smart money will, and this is a logic that you need to remind yourself every single time you look at the chart. They are obligated to distribute their orders from a liquidity pool to an opposing liquidity pool. So in this case, they trap people. Of course someone sold that there, of course someone sold here, and into the retracement quote unquote higher. They trap institutional player, retail trader, they trap participant in the market into thinking that price will go on one way, and it's okay, because if you have a risk management, you know, I'm wrong, everyone is wrong sometimes, but with risk management you control your losses. But by the way, I'm diverging from my topic. So of course someone sold down there, and they trap people in the wrong spot to accumulate counterpart position to distribute where? Above this high and above this high. Then I said that I will touch on candle range theory. In my journey to trade, I always use candle range theory in some way and never call it this way. Romeo taught me 1 year ago when I did a live call with him, and it's a logic. It's not a pattern. People think that if you have 3 candles like this, if the second one wick only below the first one, that's a pattern, okay? You need to target the eye of this candle. No. Yes, if the context around it is supporting the idea. So, in this case, let's come back to where it is there. Yeah, let's come back in here. So, you do your analysis and you come to the conclusion that the XY is bullish. You are waiting. This is a weekly chart. So, you are waiting to see a key level being hit, and what is a key level? Previous month low, for example. If you are bullish, you know what I mentioned, that we're coming off of this breaker block, and the objective is here and potentially here, and this is a retracement. Order flow on the weekly chart is clearly bullish, so you need obviously confirmation, but you go down to the lower time frame. This is a range, this is a clear and defined range, and the new month start here. So I'm saying something to build you the context, but you mark your range low, you mark your range high, and so if you expect that the following month will be bullish, you want to see a manipulation down. No, basic of power of 3. What is this range? Back to the weekly, it is exactly this candle. This is the mean of candle ranges also. And let's finish the example. At the end, you wait for the manipulation down, and the month start developing OTE and go. So that's the logic, and that's how I and Romeo trade. So, but for example, let's go back to our. Oops, you're not supposed to see that. Let's take another chart. No. This. So, if you saw my last trade on Twitter of this morning, I took a scalp because I was busy this morning. I was driving and I couldn't steer the chart. But this is the current weekly candle development on the hourly chart. So we got higher. We were coming off of a range, a clear range, choppy market, and I didn't trade Monday, I didn't trade Tuesday, but when I see, I have a friends on chat that catch this beautiful trade. I missed it, but this is a true breakout of the range. I'm not saying we are going to target this high or this, but this is a true breakout of this range. So vacuum block, pretty rare, but it's another block with a gap in front. And another meaning of candle ranges in the context, and then I will on the next lesson I will touch on some models. I will explain how I trade these models because I have multiple models and one system, because the system that not only works and not only the one that Romeo teaches, it's that, but this system is simply how the markets work. And I will touch on that, and I will talk that, but this is Monday. Now, when Romeo talks about Monday range model, what it is referring to? Simply viewing Monday candle as what? And I posted it on Twitter some days ago. A specific time range, not a price range, yeah, also, but a specific time range. Turtle soup at 50% rejection. Turtle soup at what time? London, before targeting the high of Monday. My trade was, in this context, was here. I missed the soup and of what? Another time. I don't know if you can understand from this, but I will explain this. It's a pretty complex topic. Soup of the Asian range. I missed this. I was not in front of the chart at the time, but I was able to enter right here to target this. And I called the trade on Twitter time-based breaker. A breaker that was formed in the Asian range. People ask me, why you want to expect the price to get down there? That's why. Candle range theory. Now, this isn't a candle you can see, but it is a session, and session are candle. London is 1 to 5, a 4-hour candle. New York is from 9 to 13, a 4-hour candle. And yeah, so the basis argument of this lesson are ranges are the key to the markets. And when you watch price, when you watch a chart, what you are looking at, you need to ask this question to yourself. What are you looking at? You need to understand what it is a PDRA, why sometimes support resistance work, like this instance. You need to ask yourself these questions. Now, when you're looking at a chart, you are looking at what? Candles. What is a candle? Now, you can say to me, it's open, high, low, and close. No, a candle is both a price range and a time range, and covers what price does inside this time range. So price open, trade a bit, reaches one high and one low, and closes here. So if price do this inside this time range, the candle will have an open, a high, a low, and a close. So when you are thinking about the CRT, you are considering not a random candle, not always a high volume candle. For example, this Monday, This Monday, that worked like a textbook trade perfectly, was not a high volume candle, was a doji. So we are considering specific candles, specific time-based candle in one specific context. And that's it, that's CRT. People get trapped in the Holy Grail mentality. And this is not what I want to. This is not what I want to transmit to you and other people that learn from me. I've gone there, I've been there, but you come to the if you stick long enough in this game, you come to the conclusion that trading is really simpler than it looks. And people tend to overcomplicate it. So the next lesson I will talk to you about how I need to figure that out exactly, but I have an idea for the next lesson. I will begin to explain the system, the only system, and you already know it. This is the fun part, but probably you know it in the back of your mind, but you're not implementing it well enough. You're not understanding it well enough. And it is really simpler than it looks. All price does is move from one price level to another price level, capturing liquidity. And it does this on a time-based schedule. And it's always like this. So, if I need to give you an homework, it's not really an homework because the real things you need to do are in the next lesson. This is an introductory one to know each other and to really understand the basics, but try to view to some markets, not limit yourself to one or two, so go to gold, the S&P 500, the commodities, forex market, even crypto, and look at the different behavior of price, because people often ask me on Twitter, on the DMs, but why you catch this trend on this time on this market and on the other you behave totally different. And I always respond yourself, watch the time I'm trading and the market I'm trading. And people don't understand what I'm saying, but it's so basically simple. So watch, for example, watch euro. What it's doing, not now, forever, what it is doing. Watch NQ, what it is doing. If you understand that, if you truly understand that, you'll be far more profitable. Your rate will increase massively because you can. This is the only way, because technicals and the knowledge come seconds. But you need to understand the current environment. And when Romeo said, watch the higher time frame behavior, he means this daily, weekly, and monthly if you are a short-term trader or a monthly range trader. But what price is doing? Because the intraday price action is very, very affected by this. So this is the homework, and next lesson I will touch on maybe one of the most important topics that it is the dissection of a candle and how to trade a candle. So basically everything you need to know. Well, let me know if you need also because I was thinking about it, if do more in-depth on PTRA's key levels, because there are some subtleties on key levels that almost no one knows, and I have some very important gems to share. Tell me if you want a lesson on that. So, the fun begins now. That's the first lesson. This is the first lesson, the first actual lesson, because the first video was an introduction, also a way to know each other, and from now on the lesson will be like this. So I prefer a presentation approach. So you have a more I present the content in a more schematic way, and you have a more precise way to learn them. So first lesson, as anticipated, will be on net worth price, market profiles, and SMT, and I will remind you, or I will go over some topics that I mentioned on the introduction, because I want you to start with the right perspective in mind. So put your mind in the right perspective before starting. And that's actually a thing I struggled with for a long time, and but I was able to find a light at the end of the tunnel. Many people die in the process. It's if you start with the right mindset from the beginning, it's way, way, way simpler to overcome every obstacles that is between you and your goals. So every journey should be engaged with the right mindset. So the first question you should ask yourself is, what are the markets? And more importantly, why were they created in the first place? The key here is why. We always the greatest trader I know, and I know some are in the Jeff's group also, but everyone always ask himself why. Why this? Why that? Why that happens? Why was my stop loss hit? Why did I miss this? Why is important? And this is the greatest why of all. Why were the markets created in the first place? The short answer is to take all of your money. And that's the reality, because the markets, and I know that can seem like a rant, but I will go over the important stuff later. But this is essential, because you will trade with the right perspective in mind. So the markets is a powerful machine, a powerful way, and not so obvious to most people, to move money in the global economy. And since the 1700, where the first stocks exchange, and go over these topics, it's not useful, obviously, but really fascinating for me. The first company to be listed publicly, the first contracts, futures to speculate on agricultural products were always created to make money circulate. Because It's another way. When the economy and the finance world begin to begin to become too complicated, the people that rule this thing needed to figure that out, a way to move money more efficiently in the global economy. And that's a way. So over time, obviously, more types of financial instruments will be created, and that's why. But the market is a perfect place to lose all of your money. Simple. And it's really, really well designed to do so, because every single price fluctuation is designed to fuck you. And I recently tweeted about this, but if you are trading for at least 2 months, I say, there was at least one time probably that you were very, very, very frustrated because price seems to always run against you, to always try to trap you in some sort of pattern, you see, or that's because price fluctuations, not movements or direction, fluctuations are the biggest thing that fucks many traders, because it's amazing how you see in price action things that are not there, and that's a human psychology. Another fascinating thing, but I will go over this. So the markets are controlled. That's an important thing to keep in mind, but not how the general public think. ICT, Michael talks about the IPTA, so the Interbank Price Delivery Algorithm, and many people think that every single price movement is controlled. Actually, if it was like this, it will be like discovered many, many years ago. And the way it is controlled must not be so obvious to remain legal, to remain doable, let's say like this. So actually, in which way the market is controlled, and some market in a different way than the other, because for example, a stock, Apple stock or the Nasdaq, if you notice, moves different than gold or soybeans or than a forex pair, because the true supply and demand of that product is more or less relevant. For example, the supply of gold is real. People, states, businesses needs gold, for example gold, but they don't need euro versus yen. So the forex market is one of the most controlled one, and it for this reason is one of my favorite and one of Romeo's favorite, because if you understand how it is controlled, then it's pretty easy to anticipate it. But it is controlled in a constructive way, so the movements of price are timed, and the price is moved by buyers and sellers, so institutional buyers and sellers, and retail in the smallest part, because we make up only 6% of the total market participants. So, but it is moved by buyers and sellers, but they can't actually go beyond the anticipated and chosen level buy smart money. So they keep price in range in a specific time, price range for a specific time period. At a specific time they release and they sponsor, and in the market profile section I will go over this. They sponsor the price movements, and if you go into your chart, you will see that at a specific time almost every day price start to rally for no reason. That's why they sponsor to bring price to a certain level of interest for their business. In the long run, so on the higher time frames, like on the monthly, obviously price is moved by fundamental reasons and global interest, and it is all engineered. Intraday and intra-week, it is 100% more controlled, because it's important how price closes at the end of the week or at the end of the day. It is a big range day. Nobody cares if price in a week go up, down, and then closes at the same price level. That's why they can play inside the interweek time frames to speculate on that market. Also, you know that, and I will elaborate over this, but economic news events are used to accelerate the delivery of price to certain levels. So, smart money don't care about us as liquidity, don't care about our stop loss. They did what they did. They provide the liquidity to the marketplace. They are liquidity providers. If you search on internet, they exist, and it's a job. So there are big center that provides liquidity to the more illiquid market, and this is a role of smart money. And the market makers, they also manipulate price to make money, to speculate like us in a different way, but that's their objective. If we are on the wrong side of the market, we are simply standing in the way. They are not coming after us. They are on their own path. So let's coming to the end of this rant to prepare you, to put you in the right perspective. Why a time-based chart? Well, after all this speech, a time-based chart is obviously the only way to see the market's behavior by the price scale, the price perspective, and the time perspective, because pattern happens on the price scale and on the time scale. When you blend the two, you get a pretty good result. And this will be what I will teach you, and what Romeo and ICT talking about. So everything else added to a time-based chart is extra. I'm not saying it is useless, but is extra. So unlike ICT, I don't shit on volume profile. I don't use it, but I don't shit on footprint charts. I don't shit on DOM, depth of market. I simply think they are more a tool to see inside the candle after they happens. So if there is a big movement in price, you can see that, for example, 500,000 lots were executed below this low. So you can see, you can say, smart money entered here, a big player entered. That's where the liquidity pool was. Fantastic. But you can see this after it happens. So you can, how people use it, how people use the footprint chart, for example. They saw a big player that entered. They see the market that moves in that direction, and they simply jump on the wave. So it is a way to look at a chart, but always in a time-based manner. Now, with this logic, you can anticipate levels of interest where that 500,000 lots are likely to be executed. So it is an anticipation and not a reaction. It's more difficult, yeah, but it is also more rewarding. And you saw that. So let's go into market profiles. As promised, there are two, and I talked about this, there are two types of markets. Trending and mean reverting, also called consolidating markets. Generally, and I hinted about this, some markets are more historically speaking trend continuation markets, and some markets are more mean reverting. So the forex pairs are mean reverting markets generally. Then on some period of the years, big trends start. Markets like commodities, indices, stocks are more trend following, but that's on a general scale. Said that, only two types of market profile exist, trending and consolidating, and we understand, we frame what type of market profile is the current one by using four actually. Highs and lows, my favorite. Gaps and order blocks as another layer of confirmation, and candle closure as an indication, not always mandatory, but another confirmation. So highs and lows are the most important thing, because as you can see, price is price and time is time, and price action can be seen through different time frames. So if you use the 69 minutes time frame, as me or Romeo, I did it sometimes for fun, or you use the 14 minutes time frame, the 3 hours time frame, those ones, not the usuals. Gaps and PDRAs and etc. disappear or appear, and so they are not 100% consistent. PDRAs are a way to internalize price action. PDRAs are important on the higher time frames because those are levels of interest that everybody can see. So gaps and etc. Also the banks see them, also the institutional players, and all the retail investors. So those are important levels, and I focus on them to my trading, not on a 3-minute gap. But markets price action can be seen to different time frames. So the only things that remain the same are highs and lows. If you try to change your time frame, highs and lows remain the same. So no, the maximum, the highest point in a range and the lowest point in a range, no matter the time frame, remains the same. So highs and lows is the most objective way to look at price and to frame market profile. So if we are breaking, displacing true lows with multiple candle closures, like in the picture on the right, we are displacing through that high. And if you look at the lows on the bottom left, we are rejecting it. So we are only wicking through it and price is quickly moving away. That's the type of signature that we want to see. So if you anticipate it, it's better. If you see that, you can jump on the wave, because that low is sponsored by smart money. Is sponsored by them. They are using it for order pairing purposes. So they don't want to sunk price below it. They are using it to accumulate long positions, while they want to distribute them higher, where not below that high, because they are quickly running through that. In this case, they want to distribute their position at a higher level of price. So when in an uptrend you see highs being rejected, that means that a reversal or a retracement is coming. So you can frame price action in this manner, and gaps and under blocks, as I said, are another layer of confirmation. So in an uptrend you will see gaps supporting price and down close candles supporting price. In a downtrend you will see bearish gap resisting price, and bearish order block, so up close candle resisting price. So that's another thing you want to check. And finally, candle closures. So as I saw, we wick below this low and we break with multiple candle closures above the high. As I said, this is not a give or take thing, 100% holy grail, because some soups are deep than others, and so it's an indication. Let's say like this. Now, where and why do we use market profiles? We use it on the higher time frames. Now, higher time frame depending on which candle we want to trade, and I will expand on this topic later. But we frame the market profile on the higher time frame to develop a directional bias, a general directional bias that will be confirmed and refined through other systems. In the next lesson I will go over this, but on the higher time frames to develop a directional bias. Also on the lower time frame to frame a potential, and also on the higher to frame a potential entry or exit point. So if we are on an uptrend, we want to buy the dips below the low. So we know that at a higher time frame PDRA, if there is a resting liquidity pool, that's a potential level for us to enter, and a potential level for us to, we don't exit at a random level, we exit above high in an uptrend. And there are specific hikes and lows to consider. Also, and that's more advanced, but market profile helps us also to identify the potential stop loss placement. What I'm saying? We know that a high that rebalance the gap or a low, in this case in an uptrend, a low that rebalanced a bullish FG, or a low that took liquidity while price was moving away fast, those two types of lows are protected lows, also called intermediate term lows. So when there is a consolidation, if we expect a bullish start of soup to happen, we look to the left. If there is a trusted low, to put our stop loss on. So a level in price, a low, that is not likely to be reached before our drawn liquidity is met, and ponder of this. It is one of the way Romeo taught me to put the stop loss. In level 1, he hinted at this, and he expanded on it later. Finally, and I wanted to incorporate SMT in this lesson because it is highly connected to market profile. What is SMT and how to use it? SMT, and I will dive again into history lesson, but SMT, or Smart Money Tool technique, is a way of determining accumulation and distribution in one asset rather than the other. It is not an ICT concept. It was first discovered by the journalist and trader and father of technical analysis, classic technical analysis, Charles Dow, in the 19th century. So it is a 250 years old concept. Charles Dow was the one that the Dow Jones index took the name from, so not the first guy on the street, and he watched correlated asset and noticed that sometimes, in general at the reversal points, while one asset put in a lower low, the other failed to do so, and that sometimes caused a reversal or a retracement, a change in the direction. Now, used by itself is a waste of time, but used in the right context and at key levels at the right time, it's a powerful tool. It's a powerful confirmation tool. It is not always needed, and you will understand why when you truly digest what an SMT is. An SMT is simply an indication to us of where, not if, where smart money, because smart money are always involved, but where are they more exposed to long position rather than shorts. So the stronger asset, and this is a photo of a recent price action on euro and pound. So the above chart is pound dollar and the below one is euro dollar. In this case, pound created a lower low, while euro failed to do so. In this case, we prefer to long euro because it is the stronger asset. But why it's the stronger asset? Always ask why. It is the strongest because smart money is accumulating long position in both, but more in euro. In the leg down in both assets, they are selling short and going into drawdown to bring price at a certain level, and that's new. But while the level of interest for pound, smart money liked this level, so they want to bring pound down to this level before doing business on pound. Euro euro, for them it was more than enough, more than enough discount at this level. They don't need to bring euro down here. What this indicate to us? That euro is in a favorable position to long because it's at a discounted price rather than pound in this situation. We simply ride what they are doing. So if they are showing this, we are with them. Simple. So it is SMT show us which asset is stronger than the other, and I forgot to mention this, but SMT, we check for SMT between highly correlated asset. So Nasdaq and gold are like 35% correlated. We don't look for SMT between gold and Nasdaq. We want a 85 or more % correlation, because you can go crazy looking for SMT between interest rate and dollar, for example, or treasury bonds and euro, but you will never enter this loophole. So focus on highly correlated pairs, S&P 500, Nasdaq, with the Nasdaq. Let the Dow away. Euro, pound and dollar. Dollar obviously is inverted correlated to euro and pound. And gold and silver. Focus on this. Bitcoin, Ethereum. Let's stick to the basic one. But the important thing, and this keep notes on this one, SMT allow us to know once the SMT is confirmed with a close above or a close below, let us know with the highly percent probability that a certain level in price won't be touched. So SMT creates equal lows, and I want only to long with the equal lows present when there is an SMT on. I want only to short with equal highs present when there is an SMT between them. So equal lows are created with the SMT on the other pairs, and when equal lows are created on the pair that create equal lows, a rejection block is tapped while the other pair took the low. So SMT create equal lows and equal highs. Left SMT leave gaps unfilled. SMT is the reason for a true breakout of the range. Let's take, for example, today's price action. Mark Monday's range on euro and pound. Pound took Monday low and then reached Monday high. Euro, simply with an SMT at the lows, is breaking out of Monday range. True breakout happens because of SMT, always, or because the range, and I repeat, or because the range is sitting at an higher time frame key level. These are the only two instances a true breakout happens. SMT, so target of soup on the other pair, or the range is sitting at higher time frame key level. So I want to repeat myself. Don't make the dumb mistake of writing SMT as a rule as a strict rule to your model, because SMT is not needed, is an indication of which pair we want to long or short, is an indication of where we don't want to see price arrive. And another thing, SMT and God are the only way that can stop your target from getting filled. So if you have a drawn liquidity in mind, when price is near, check for SMT. Because if the drawn liquidity is an FAG, relative equalize, a previous candle highs, or whatever the fuck it is, the only way it will not be reached is because of SMT. Go over this lesson again and again, and we see each other next week. And obviously, let me know if you have any questions. I'll do my best to respond. Hope a good rest of the day. See ya. And I was expecting some bullishness from this month, May closure. This month closed above this candle, and as you know, close above indicates not guarantee, but indicates higher prices. And so obviously it's an indication, and you need to build other layer of confirmations on the lower time frames and with the development of the next candles. But this close above indicates to me that we want to reach, as you know, as you can see, we rejected the 50% of this week, this long week that stabbed into this rejection block. Here, a trade that Romeo took, if you paid attention, but we rejected the 50% of this week closing above this. And so the body of this candle was likely the wick of either the wick of the body, in this case the body, acted like a bullish order block to send price higher to the wick. So this was the macro perspective, and keeping this in mind, on the weekly we can very clearly see that the body refused to close below this intermediate term high inside this daily FG. But this was pretty inside, so you saw this here when this candle closures, so you need to keep high for potential bullishness. Also, if you want to view the market on a macro perspective, current seasonal tendency for the XY are bearish. I will send you in the chat a photo, schematics of the seasonal tendency of dollar, and in this month of the year they are bearish. So obviously that suggests a potential bullish scenario for pound and euro. So keeping this in mind, on the daily we were consolidating right there. This week was what I called a consolidation week, and it doesn't mean necessarily that you can trade a consolidation week. I will show you how you can trade a consolidation week if you so choose. And an anticipation is, look at the money range. You will play this not expecting an expansion, because the week will be a range. But I will dive deeper into this on the future lessons. But from a consolidation week, we expect a small body candle means chop on the lower time frame, and an expansion is needed. We expect an expansion next. To To time the expansion, that's another topics, and in this case it was the open of the new month that started the rally. So small little Judas of the month and also of the week and rally. Also SMT between these lows, as you can remember. But so focusing on this trade, we have this week already closed. So a huge expansion week towards, and the obvious target was previous month high, this. And the high, and listen to this closely. If you study rejection block closely, you will see that rejection block are truly an amazing PDRA, and that they provide a beautiful entry, precise entry, and precise exit, because I always suggest to everyone to close the trade at rejection blocks, unless they are already tapped, obviously. Rejection block, in this case, if you were long from down here, and if you go on my tweet, I quote the low of GU, and I closed the trade almost here. But if you were long and you were aiming for the week, this week, you would stand all this retracement and chop before the week will be taken. So always close the trade at rejection block, because most of the time they will provide a reaction before the week is taken. So in this case the reaction was already provided, so the probability that price will run through this high, also relative equal to this, was very, very high. So previous month high was the conservative target, and that's where I closed my trade. I didn't hold for this. This was it during the CPI event. But, so, keeping in mind all this, we were in this, I will use the replay that I earned taking this live, but this is what we were seeing. As you know, we plan the week on Sunday, we skip Monday, and we look to enter on Tuesday. And I will expand on that on the next videos. But this was the scenario in front of our eyes. And without the context that I already give you, only looking at this chart, the most likely expansion of the next weekly candle will be towards, at least towards this high. We don't want to predict the closure of the candle, we only want to trade the expansion, and the expansion is all we need. So let's remove, and so I keep my chart clean all the time. So I want to have only some level highlighted, in this case the draw, and I want to find a higher time frame PDRA, higher time frame relative to the time frame I'm watching the power of 3 of the candle. So on the weekly I don't see anything. On the daily I see this beautiful FVG formed after Monday, and one of my rules, and again I will expand on the rules, I will expand on the system, I will expand on my personal approach later. But one of the rules, if I'm trading the weekly range, and only if I'm trading the weekly range, is skip Monday. So like, if I'm trading the daily, I will skip Asia. And that's some food for thought. But we skip Monday, and we see, I saw this FVG formed. So the FVG paired with the Monday range. As you know, Tuesday has the 70% chance of printing the actual higher low of the week. So FVG, daily FVG paired with the Monday range paired with higher time frame institutional order flow towards previous month high, this was a high probability trade. We go down to the hourly, the time frame I like to use to frame the weekly profile, and we mark out Monday range in this case, because I'm expecting it to be souped. So Monday is from 17 to 17, the daily range, and I marked manipulation time this line. Try to understand why. I will taught you that, but try to understand why and give me the answer in the chat. However, Tuesday open as a session consolidates around where 50% of Monday range, CRT candle range. This is the correct way of using candle range. Candle 1, candle 2, Tuesday, candle 3, distribution Wednesday. However, Tuesday opens, consolidates, fake breakout, all the buyers, and I have some, I don't know if you saw, but someone on the UTS group actually bought here, but consolidates, false retail trap there, of course someone bought here, breakdown, someone sold down there, break up, rejection block, and fast sharp move into our higher time frame PDRA, higher time frame key level, below, stabbing, this is a stab, a fast move and a failure to displace below this low, creating also an what the fuck is the an SMT divergence with pound. So British pound, no, sorry, with the euro. So euro, I'm down. So euro failed to take Monday low. So what the fuck am I doing? So GU created a lower low while AU failed to create higher low. And if you watch my recent lesson on SMT, I talk about this. And if you, I said, always trade the stronger pair. And in this case, euro made a higher low. But the reason, and euro expand also, so there were no wrong answer in this case. But the reason I choose, and I saw euro, but the reason I chose to trade GU, and as you know the delivery was far cleaner, was because on the higher time frame, on the daily, it was far bullish than euro. As you know, it was far bullish than euro. The probability were higher, the setup was cleaner, far cleaner. And so you need to factor in also the higher time frames before taking a decision on which pair to trade. Or you can trade them all. At the end of the day, even if you choose the slow pair, the weaker pair in this case, both will move upwards because they are correlated pair. So if you are right, the trade will be played out anyway. The SMT stronger versus weaker trick is a more advanced topic, and I gave you all you need in that lesson. Also factor in the higher time frames. That's why I choose GU. However, Tuesday, let's come back to us. Tuesday, stabbed candle number 2, stabbed into our higher time frame key level. At what time of the day? And on UTS, they asked me, how did you enter right here if there was no lower time frame changes state of delivery, even on the 15 minute. Yeah, there was this that actually supported price towards the Asian session of Wednesday. However, I didn't wait. I entered here. And the reason I entered was time of day. It was towards the end of Tuesday candle, and there isn't an algorithmic mathematical way to say this. It is the experience, and with the experience you will begin to trust price action. You will get a feel for price action, but I will explain the better I can. So it was here the candle, the actual daily candle of Tuesday closes on 17, 5 p.m. So from the open on 17 to the close, it was a consolidation, seek and destroy profile, fast move down, and this was towards the end of the candle. And as you know, Tuesday will make the higher low 70% of the time. With an SMT, I entered here confident that towards London close and New York close, price will move upwards, and Asian session won't take this low out. However, my stop loss was a bit conservative, and I put my stop below this hourly wick consequent encroachment. So my stop was at, if I remember the level correctly, was here, more or so. Yeah, my stop was just below the consequent encroachment. Highly unlikely to be tapped, but if it was tapped, I wanted to see an immediate reaction from Asia. As you know, Asia spikes, but didn't take out this low. So my idea was not even closely invalidated, and the trade looked like this. Entry, a stop loss, target 1, Monday high, target 2, previous month high. This was the trade. And yeah, so partial at Monday high, closed the trade here. Could have let a partial in hindsight from previous, the high that I talked about, right here. However, hindsight is a dangerous beast. In this market condition, I prefer to keep this. I risked 0.8% to make almost a 7.5% return, a 7% return. It was the trade, clean one, nobody taking it, nobody. And the cleanest one of all. I hope you enjoyed, and see you in the next. So this will be the lesson on turtle soup intricacies and order pairing logic, lesson number 3, I think. And this will be maybe a shorter one because there is less to say and more to understand. But let's start with what is turtle soup. So turtle soup, and this is a trade, this is a trade I took. So turtle soup is a force breakdown, a force breakout in this case, above an old high to redistribute lower. So this is the only way, and you need to understand that, because once you truly understand what this means and what this allow you, why the fuck you want to trade everything else? I mean, this is the way, and it is easily predictable if you use the correct techniques, but this is the way the market moves. Every market in every time frame, in every time, because before every single big move there is either a total super or an S&T, period. And the reason why is because this market are used by big player, and I'm not meaning hedge fund, pension fund, treasury fund, not those big players with big pockets, even though they are, but by the market owners, by the smart money, so-called, the ones that moves the market, the ones that have control, true control over them, and they want simply to make profits. It's reasonable, and big market moves are the Fed, the BCA, Central Bank of Europe, are the Central Bank of Singapore, Japan, and those are smart money. Those are the ones that make money for the states. The markets are a way to circulate money around the world, and to enter or to execute their orders, their position, they have too big of a capital to do that. And so they use, in the modern area, they use algorithms. Algorithms are the one that ICT spoke about, that the market is guided by algorithm, one algorithm, they say. Actually, there are more, and they operate on every single time frame, even though mainly on the high one, because the interest resides on those, but the logic is the same. Stop orders, not your stop on your small broker, I mean larger stop orders of institution, like hedge fund, like real firm, and those kind of places. They have large orders, large position, and those positions are triggered, are induced to be created, to be accumulated at a certain price levels. What levels? Levels of interest for smart money. Stop orders are aggressive orders, like market entry. So they will hit, in some way, they will hit smart money resting orders, and I mean limit. In this case, smart money will put all kind of limit order here. Limit, sell limit, sell limit, sell limit, and they are placed by algorithm. They are placed and removed to create artificially a drawn liquidity at a certain levels. And once price reach that levels, they are executed. Why? Because people, and with people I mean funds and also retail traders, even though we are very small in the marketplace, but people buy up there. People buy either because they are in drawdown and they want to exit, or because they want to ride the wave up, what they think it is a way up. So they buy, but those buy market orders, because stop order are aggressive market orders. If you want to study truly how the market works, how each order interacts with each other, go study them. I spent 4 months understanding this. But they will be hidden by limit, sell limit of smart money, and they are placed not all at one time, but slowly and steady, one by one, until the markets tours, because there are not more buyers anymore. So the sell of smart money cause the markets to go down, and these sells are placed by algorithms. It is 100% controlled. Same when they want price to remain a consolidation, they sell, buy, algorithm sell, buy, and they keep price in a certain price level. And this is the order ampere logic. When you want to buy, you buy, sell stops. When you want to sell, you sell at buy stops. You want to do like smart money. And this is turtle soup. This is why it's my only way of entry, only favorite way of entry, and this is why I'm so precise. I learned by Romeo, and you know his precision. Then I wanted also to touch on, I wanted to say this. You know, I assume you know the type of market or footprint charts, all of this, like institutional trading. Online it is publicized by that. They are great tools. You pay for them, obviously, but they are great tools. You can use it to see inside candles, inside charts. But think a bit. What you see what is already happened, obviously. I mean, you can't see the future. So you can see that at certain levels, big money sold. If you go to a footprint chart, you see that in this candle, this week, big institutions sold. And once the market turns, you say, oh, this was a place where smart money sold. And what you do, you sell here, maybe here, in any retracement, because you know that high is sponsored by smart money. And that's amazing. I don't use that software, those software, but I entered here. Why I'm telling you this? Because I'm teaching you how to think like smart money, not seeing what they do. And by the way, you can't see with the depot market, you can see Forex market because it is a not centralized market. You need to use mainly only futures. So you are limited by doing this. I can trade every fucking thing because I know how they think. I know how to gauge, how to predict which, and obviously I'm wrong, but that doesn't happen often. I can assume which level they are interested in because they work on a time schedule. Time. Price levels, and time. That's the only thing I'm looking at, and ranges. So this is to say to you that you can do this thing, and the how to do it is really simple. You will understand it with the next lesson, and especially in lesson 6, the one on time. That lesson is and I have to record it, but it is the best one so far that I can do, because it will give you a system and a true understanding of the charts. But let's come back. Turtle soup intricacies. Every turtle soup will always happen above, if bearish, above the opening price of a candle, and every single very bullish turtle soup has always happened below the opening price of a candle. And that's empowering, because you know that you have to wait for power of 3. And you can say, okay, but let's just say this 50-minute charts, okay, this is a turtle soup, the first one I can see. This is a turtle soup, so all the high, turtle soup. This happens below the opening price of the week, and okay, however, it happens above the opening price of what? 5 minutes. Just to see better. Opening price of what? The 5 AM candle. And this is food for thought. You know that you need to wait for power of 3 always. The algorithm function in this way, and so you trade this way, and you'll understand very deeply this time concept in lesson 6. It is just a an hint I'm giving you, but every single turtle soup you can see, as always, the power tree behind it, and that's beautiful. Also, every single turtle soup has always happened at a higher time frame key level, no exception, none. The only one that happens not at an higher time frame key level, because higher time frame key level are inferior to time, at least to me, are the ones at all-time highs. And in fact, I can trade only based on time, without a higher time frame PDRAs. However, they give you roughly a depiction of the zone you are looking to buy or sell. So you need to use them as a confluence with time, but time comes first, because higher time frame key level without time are useless. So every single soup happens at higher time frame key level. Every single soup happens above the opening price if bullish, if bearish, or below the opening price if bullish. And let me check my notes. There are two types of soup, and maybe three. I tell you now. So there are continuation soup and reversal turtle soup, and those are relative to the time frames you are looking at. And this is mind-blowing, because continuation soup doesn't require higher time frame PDRA. So let's go to the daily. This is a trend on the S&P. This is the reversal turtle soup, right? Your market profile is bearish, you are breaking through lows, and this is the reversal turtle soup. From now on this time frame, on the daily chart, every single dip below a low has to be bought. So dip below a low, also FEG, bullish turtle soup. Dip below a low, turtle soup, continuation turtle soup, sorry. Dip below another low, continuation turtle soup, never close below twice. Same thing here, rejection block, buy, and so on, so forth, until we broke below the low that broke the high. From this point in time, we are bearish, until the reversal turtle soup. So, sorry, this low, reversal turtle soup, and we broke above the high that broke the low. Market profile is bullish. Every dip has to be bought. This has gone below, and so on. You understand? Remove everything, and so this is the logic. The continuation soup doesn't require a higher time frame key level. Reversal soup does. However, as I said, this is relative to the time frame you are looking at, because let's keep this in mind. This reversal turtle soup, how do you enter in that? You see me enter in reversal turtle soup all the time, actually. How do you enter in this? Zoom out? Monthly chart? What is this? It is just maybe weekly. It was no, monthly, sorry. Monthly chart. It is a retracement, quarterly shift, inside this order block, and actually it was this one. I take and I will explain this why wick to the body. This is the thick down close candle that stabbed into the low. Close above, not here, not here, not here, not here, here, close above, means higher prices, retracement into that. So it is simply, on a higher time frame, a retracement. On the lower time frame, it is a change in market profile. And I know this seems obvious, but it is so important to understand, because this is the way you trade So I need to check something. This is the way you trade the higher time frame. This is a 3 months candle. So a quarter. This is a quarter candle. Look, open, fall slow, skip the first portion, turtle soup into the key level, pre-manipulation liquidity pool, and rally. Power of 3 of a 3 months candle. You never saw that, eh? It is applied to everything. And this is how you trade a candle. You always enter in reversal turtle soup because they are simple continuation soup on higher time frame key level. Same thing I did right here. And go back that and go reverse engineer this trade on ES. It was a hyper reversal turtle soup. Everyone was bullish up there. Everyone was targeting those relative equal highs. They were more prominent on Nasdaq. See? Everyone was bullish. They want to buy the retracement. And I sold to them. However, this was a continuation soup on a higher time frame. Yeah, a retracement into an higher time frame key level, and go find the key level out. So this is the logic of turtle soup and how to frame it. The other type I was speaking about, and I called it a type because it isn't really a separate way, but it is only an intricacy of turtle soup. It is the range turtle soup. So here, for example, this is a range on BTC daily chart. This is a range low, range high, and this is a continuation soup. No, sorry, this is a reversal soup for this time frame because we were trending, breaking highs and rejecting lows until we begin to range. We begin to stay within this range. We rejected this high, we rejected again, we broke below, and we formed a range. So this is a reversal turtle soup because from range market profile we go to trend again. And this happened to be the same direction of the previous trend. Sometimes it can be a topping range. What happens because on this soup, this is simply a retracement into a higher time frame key level. No, it was on the weekly. See? It was simply a little consolidation above this weekly FVG. And it is what you call a retracement in a weekly trend, right? So it is the same way of seeing the turtle soup on like the previous one, but it is a way to keep in mind. And there I will hint to this, I will elaborate better on lesson 6, but there are certain times for ranges and certain times for manipulation and certain times for expansion. So keep this in mind. So coming back to us, let me check again my notes. Now, I also wanted to speak about shallow versus deep turtle soup. Because I think in all this time you have wondered, but how deep a turtle soup can be. And there are truly two ways of determining the journey of a turtle soup of price below an order low or above an order high. The first way is to consider the range before the manipulation. If there is a range, and this isn't a holy grail, this is a way of confirmation, standard deviation. So the range before the manipulation. The second way, it is the higher time frame key level. And understanding the higher time frame key level, you can gauge how much deep a total soup can go. Actually, there is a third way also, that it is time. Once price reach a certain level in a certain time, you can not predict, but you can not force, but you can expect a reversal, because as I said, the market works on a time schedule, and if your ideas is correct, it should react to a certain times. So what I mean by range standard deviation, it is what you think. So on the daily, for example, let's keep this. I go to euro because I choose so. Let's keep let's take, sorry, this day in mind. No, they were London from the high. Don't know. Let's take a random day, and let's see if I'm correct. So let's take this daily candle. Okay. So here there isn't. Okay. Here, let's take this an example. Asia, it was the range, the time range before the manipulation, and in this case it was 20. Asia is 20 to midnight. The range is, and you can extend obviously this until here, because you can see the price range is still the same. So the low of the range is taken out with the manipulation, and it didn't reach a standard deviation of the range. Why? Because let me, okay, because the higher time frame key level was there. So see, you were already inside the higher time frame key level, and price waited, let's make this a light blue, and price waited for the correct time to rally. Price was already inside in Asia, see? Was already inside the key level, but waited for the time. That's why time is more important than price. In this case, a classic standard deviation of the range, like 0.5, won't occur, and this is a case of a shallow turtle soup because price was already at the key level. I give you an example of this. Let's take some other days. Maybe this. So opening time and closing time, 15-minute chart. Okay. So in this case, the range, you need to consider time. So Asia, you know, is from 20 to midnight. The price range of Asia is here, and here the low, that it is the same before and after the manipulation. So you keep this range in mind, you project the standard deviation, and in this case, yeah, shallow turtle soup. Why? Let's see, because the higher time frame key level was already there, and maybe also a daily, no, for our FVG, you were already in the key level. Again, you see, it's the same thing over and over again. You were already in the key level, but price waited for the correct time to rally. correct time. Why? Because this is the end of Tuesday candle, not the correct time. Asia, not the correct time. London, yeah, love the day. I can search for another example. So 11, range, no, I want, okay, this is also a trade that I took, you remember, the time-based breaker? Yeah. So this was an example of a standard deviation where you can use standard deviation. 17, range, Asia, 20, midnight, this is the low, that it is the same to this, almost. So, pam, 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 and the standard deviation was 1.25, because it is 25, half, one full standard deviation, 25, half, one, so, and in this case, half of this, because the higher time frame key level was this hourly order block. So price needed to travel a bit more because the higher time frame was not reached, higher time frame key level. So you understand everything, and standard deviation on the weekly chart are used on Monday range if there is a Monday range. If Monday expand, you let it expand. And go try it for yourself. On the monthly candle, it is week 1, if week 1 is a range, and that's it. So you can use standard deviation, but the main thing is the higher time frame key level. That's your benchmark. Now, I wanted also to talk you about the rule of displacement, because as you know, if you see price that smack into your key level fast, you may be scared of it, but it is the best thing, because see, price travel faster, everyone is bullish in this case, and go down. This is, and yeah, that I already told you about this quote, but the real moves in price are the steady ones. There is a clear example here. The real moves in price are the steady ones. The steady one. The sharp move are the fake one. And when there is a sharp move at higher time frame key level, it is where a soup is cooked, turtle are cooked. See? Because sharp moves are artificially created. So the role of displacement, you want to see generally displacement into the old high or the old low, through it, smacking into the key level, and a reaction, a stop. In that, you need to say that speed in price, that stop. It is like a stop. So, speed and stop. Accumulation, okay, it's okay, it's okay. Price is waiting for the correct time. Time to go down. Asia, stop, correct time, rally. Okay, but you need to see that enticement, that quickness in price disappear once it reached your level, and it is the same every single time. Last, random soup. No, my soup on yes. Okay. 1 hour. It's better seen on the 30-minute chart. You can see price was slowly and steady. It was calm and nice, and then fast move in London. A second fast move and stop. There, gyrates around a bit, and drop. So the quickness in the entry and the quickness in the exit after you witness a reaction are key. And the final confirmation is the broke through, in this case a huge gap. It is even better, broke through the low that broke the high. because you need to probe, not forget the old teaching, the old lesson, because I'm building slowly your house brick by brick, and every information is important. And this is what I said is I will expand to this in lesson 6 and finally in lesson 7, maybe 8, because lesson 7, the 7th chapter is really dense. But yeah, I'm always interested in the range at the top of a candle, not video rays, not other shit, only in the range in the top of a candle with my time frame key level. And in this case, as I told you, it is for you to find and for me to know. So write me in the chat, reverse engineer this trade and tell me not only what was the key level, but why I was sure that this was the eye of the candle. Final thing I want to say is the model 1 logic, because as you know, I hate pattern and I mean it, so I don't look at video arrays, only on the higher time frames. On the lower time frames, I can't give a fuck actually of a breaker or an FEG. I'm truly doesn't interested in it, only in highs and lows and time on the lower time frames, so the time frames I'm trading. But logic of model 1 is key. Candle number 1 is the candle that is used to start into an old high, and in this case, let me check. Yeah, you need to go to the time frame where you can see a thick candle that stab into the old high or low, obviously with the logic behind it. It is not a pattern, it's a logic. They use this candle, they inflate this candle with liquidity, with buying pressure, because smart money, yeah, algorithm buy for smart money, as I said. So this is used to dig into the old high, and once it is broken out of, because candle arranges, when price broke out and closed below, this becomes a new level where smart money sell, or the algorithms sell for them, sell. They can't, and I told you why, they can't go over this candle again, because they will be in net drawdown, and because they control the market, why the fuck should they go in drawdown again? So once they do this, so they sell them again inside of this candle, because this is fair value to them, fair value. And yeah, I will, it is a range where you want to sell, and so if you use model 1 as your entry of choice, you need to put always your stop above, because I explained to you why above model 1 candle. Always, because it is a range where smart money sell. Sometimes they touch the rejection block too, but the logic is the same. You need to stick to your bias until it is invalidated. Same here. On the daily, same candle. You need to go to the time frame to see it, but candle that stab into the low used as support to buy again. See? And this is a trade on itself on the lower time frame. I assume that if I go to the lower time frames, there is a candle, see, candle stabbed into the low, close above this whole range is used adds a zone to buy again. Same logic. You can't go to the 1 minute and expect that to hold. You need to witness on the candle that stopped the low, because some people, let's say, yeah, it is not an order block. I mean, this is the low, let's say, and you go to the well, let's use, okay, well, any low truly. Okay, let's keep my trade as an example. So this high, the candle that actually stopped into the high was the time frame where it shows was this hourly candle. You see, the first one, because obviously on the 4 hour there is one, okay, and it will work in the same manner. But the first time frame where you see a candle that from below the high to gone and close above to the high, or stopped, the candle that actually stopped the high, because you can say, okay, model 1, yeah, but never close below, so never close below this candle. It is the new candidate to be the model 1, close below, okay, my model 1. What I wanted to say, if you go to the 5 minute and you search for the same thing, you can take this, okay, close below, no, work, stopped out. Okay, order block here above the eye, close below, stopped out. It is not an order block, it's a logic. The range they use to stop the low on a higher time frame. I mean, you can't go to the 1 minute and assume, in this case, this hold. But why? Why? Because it stopped into the high of this candle. See? The eye of this candle. The candle, where it is, okay, the candle that stopped into this eye, once it is close below, it is used as model 1. And yeah, it is fractal, so you can use this as an entry to trade the weekly range. I didn't do that. I entered in the turtle soup itself, so right there, more or so, and this. But this is the logic of model 1. So never be afraid of miss a turtle soup, because if you miss the soup, you have the confirmation and you can use model 1. The reason I didn't use it, I don't use it as an entry of choice, is simply because not every single time it is retested. Sometimes price is in hurry, smart money are in hurry to make profits, and it is simply run away fast, like in the last example I took here, the last trade I took, this one. Model 1 wasn't, and by the way, my target, I wasn't stopped out because my target was this, and go understand why. The reason is, okay, I say to you why, but I low discount and premium, first key level in premium, and also paired with time of day 13. You will understand why, but this was a perfect exit. I exit right at this level, at 13. But in this trade I took, for example, model 1 wasn't tested, and so you have missed the trade. In this case I entered in the soup, and so it was a clean one. And this was based on time again. Every soup always happen below the price of a candle or above if bearish. Keep this in mind. And my confirmation was when you broke above the high that broke the low. Everything I'm saying is important. And next lesson will be on ranges. I touch on them a bit, but I will teach you advanced range theory, and also why CRT is important, and how truly to use it. So I see you in the next lesson. So welcome to lesson 4 on the advanced range theory, and this paired up with the next lesson on key levels, and obviously the one on timer will clear out a lot of doubts, and also will help you with not only with viewing past trade in a different way, but with entering new trades. This knowledge is one of the main reasons I have the precision I have, and yeah, I'll go through with you. So first of all, a concept that you may know or may not, but it is fundamental, important. So the market moves in ranges, and trends. Ranges, and by the way, every line is done on purpose. In range and trend, in range and trend. And so on. So every concept, everything you're doing can be summarized in this. Power of 3 is the time aspect linked to this. So range, trend, power of 3, beginning of the candle, range, total soup, trend, below the open, for example, or imbalances, fair value gaps are, occur when the market is displacing in the trend, and within the range, pattern trading will get wrecked, buying or selling every bearish or bullish FVGDC. Order blocks only works in expansion, so trend, consolidation or range is building of interest, and this lesson focuses on how to define a range. So first of all, for what you see, after every expansion a range is due, and a range happens when the drawn liquidity is met. So for example, here, bearish market profile on this time frame, important, on this time frame. So we have a range, an expansion, a trend, range, trend, range, trend, range, total soup reversal, and the market keep expanding until the drawn liquidity is met. Once the draw is met, we expect what a range to form, and potentially a total soup to continue higher, or a total soup to reverse, or an SMT to reverse down, because there are two types of ranges. Well, range is one. It is used in two different ways. The one way is continuation, and the other is and continuation simply mean that the market makers are interested, and I tell you this on the total soup lesson, to redistribute their orders on higher price levels. So in this case, this is a range, and the market continue in the same direction of before, because the interest in market makers reside lower. then happens what? Distribution tops and bottoms. So in this case, this was a distributive bottom because on this time frame, on this fractal, because the target the market makers had in mind was met, and now the interest is changing to bring price higher again. Okay, so now that you understand the logic, because everything I do is based on logic and narrative, not on pattern, I want you to know how to identify a range. So a range is simply the creation of buy side and sell side. Let's take I don't know, this as an example. So a range is the creation of buy side and sell side on both ends. And it's simply when price is behaving, is rejecting both highs and lows inside two defined price levels. There is usually a way to validate a range, and it is by taking its 50%. And one thing you will see over and over and over again, and that proves that markets are controlled, is that the 50% of the range, you can measure it in this case from this point in time onwards, because the high of the range is created here. So once price drop, this is the high, this is the low of the range. And you can measure, like I did, the 50%. But you will see that the 50% is respected even before the actual range is created. This is one of my favorite proofs that markets are controlled. So a range is validated by its 50%, and then one extremity is taken either by a total soup or an SMT, so a total soup on the other asset, to accumulate position. And I posted this because it's really clear, to accumulate position and to redistribute to 50% other side of the range and potentially beyond. So a range is that. Then I'll get also into CRT later, but for now let's focus on this. Then usually at 50%, a strange thing happens all the time, and this is a trade that can be took on the lower time frames, but it's very advanced. And I take this on AVAX some months ago, when it was moving pretty nice. Now it's a shit, but usually it happens almost all the time. A turtle soup at the 50%, at a neutral level, to bring us to one extremity. And it is very likely that this movement is the false one, like in this occasion. But this is a trade, an advanced trade, because the rule of range trading are buy, or at least consider buying range low, don't buy, sell, or at least consider selling range high, don't buy range high, don't sell range low, and do nothing with price is inside the range. That's why this is an advanced entry, and not every time it can be anticipated. So the safest way is to identify that market is ranging on the time frame you want to trade and engage on the extremity. Then target 50% and the other side of the range. Same thing here, and this is the trade I actually took. Range low, range high, and by the way, another thing is CRT. So I will give credit to this. Sorry, I'm checking my notes. After that, I will tell you how to distinguish a true breakout from a false breakout, because as you know, And if you're trading for this concept for at least 2 months, you've noticed that sometimes a range is truly broken. But I will bring CRT to this. So range low, range high, many times the range low and range high are both of a candle, and the high and low of a specific candle. And not only because it is a candle on its own, but a specific candle. And I mean, in this case is Monday, the Monday candle, specific one, all the week range, Tuesday, reversal. And if you study ICT weekly profile, you know why it was Tuesday to reverse. But it's same. So every single year, also this Monday high, and it's not all the time Monday, just so you know. I will give into this on lesson 6, but range 50%, validation of 50%, so you can't see, more or so it's here. So range, turtle soup, target 1, 50% reaction and 50% turtle soup continuation, other side of the range. It's always the same thing, and the specific candle I was talking you about is not always Monday. It is a logic, and you need to apply it with a higher time frame candle in mind. And that's why I said on lesson 6 it will be clear. But I will give you a hint. Well, in this case, it was not. I want to find an example. Okay, like this. So this is a daily chart. So think in perspective of the weekly candle. So Monday, range, week above, lower prices, and we bring price to the other side of the range. I took this to here. It is on my Twitter, the one I said I draw the failure swing. It is on my Twitter. And Wednesday candle, souped on Tuesday. And I emphasize the days for a reason. So Monday, Tuesday, Wednesday, Tuesday. Thinking in perspective of the weekly candle power of 3. And answer me on the chat of why this is high probability. So CRT, you need to consider specific candle, keeping in mind higher time frames, directional bias, the order flow, the current market profile, the state, so ranging, trending, what are you doing, why, the time of when it's happening, what week of the month is this, in this case, what week of the month is this, and those are specific hints. On lesson 6 I will go over all of these topics, but for now, think in this perspective. So by the way, CRT, every candle is a range, and same range trading rules applies to each candle you need to, on the higher time frames you want to focus on. So never buy candle high, never sell candle low, take profit at 50% and opposing end of the candle. Same thing. Now, one of the most important topics, how to distinguish a true breakout from a false breakout. And there are many ways to do that. One thing, probably the most important one, is higher time frame PDRAs, because every single total soup happens at an higher time frame PDRAs, and it is rather subjective, but what's not subjective is the time of the purge and the higher time frame market profile or directional arbitrary flow. So in this case, let's keep this as an example. No, no, not the trade I'm currently in, but like on the lower time frame, something new. So I'll go like 5 minutes. Okay. Well, this. I want a flashy example, so I'm searching. Okay. Like this one. So we have a range, a clear and defined range, so we have a range, total subtrend, validation of the 50% check, 50%, see, but also truly respected. Okay, now price drops faster to the other extremity of the range. How do you distinguish that this is a false breakout and not a true breakout? You keep in mind the higher time frame direction. But even on the hourly, what is the current market profile? Well, let's do on the 4 hour. What is? We are rejecting highs, rejecting lows, because we are on an uptrend, so rejecting lows and breaking highs, and the objective is this high. In this case also we are on a range, total sup of one extremity, and give to the other side. So we are on a higher time frame directional bias, and I think you have noticed this, but this is also a specific candle total sup, and I took this also. Euro is my bitch. I like to trade euro so much, so, and not a random candle, but 9 p.m. 1 a.m. London. So think you need to keep in mind the higher time frame directional bias, close below, close above, wick above, wick below, ranges, and current market profile. You can go even on the daily and have the same expectation. Well, you remember this. So on the lower time frames, if the higher time frame is bullish, every single drop below a low is to buy. And then beautiful retest of range high, also the high that broke the low, broken truly, market profile, basic of market profile. So, also there are other tools to understand a true breakout versus a false breakout. So multiple close below and close above. The high is not a good indication, but it isn't it isn't the holy grail to understand this, because as you see, multiple close below the low of the range doesn't necessarily mean a true breakout. So you can consider this as a tool, a respect to the low or to the high, but generally focus on time of the purge and higher time frame directional bias. And when you are expecting a reversal always happen with a reversal. So market profile is bullish, then every single lower time frame range will be, if market higher time frame direction is bullish, market will continue higher. If you are expecting a reversal to happen, it will always happen at a higher time frame, always with a range below higher time frame key level, or at a higher time frame key level, and this is when a reversal on the lower time frames will happen. And then these are the occasion where you need to have an higher time frame PDRA on a reversal. Otherwise, buy the dips below the lows. And obviously reversed, if the higher time frame is bearish, sell the pops above the highs of every range or every candle in this occasion. And when you're expecting a reversal, you need to have a specific time and a specific higher time frame PDRA. This is always on the time frame you are trading. Hope it's clear. And yeah, this is a rather simplistic lesson, and the next So finally, after some time, I was doing an exam and a lot, as you know, but we are back, and we are finally at the most important chapters in the lesson. As I wrote in the message, I have decided to do an in-depth lesson on key levels, PDRA, how to frame bias, because it's probably the most important topic and the one that, on which people struggle more. So I felt like it was a good idea. And then the other lesson that will be ready today, as well as this one, will be on time. And I want to do these two lessons together because they are, as you will see, very closely correlated. And so one complements the other, is the next step to the other. So let's start with a random chart. First of all, ICT revolutionized the trading spaces, and his way of viewing the markets, his way of seeing a technical analysis is amazing. But I must say that PDRAs, I use them obviously, but it's not the way, it's not the reason behind why price moves. The reason why price moves is because of liquidity, and the movement of price are dictated by time, because they are on a schedule. But the reason price move is liquidity. There are bigger entities that speculate on this market like we do, and they bring price from a liquidity pool to an opposing liquidity pool, to an opposing liquidity pool, etc, etc, etc. They do business in other ways. PDRAs are just a way to view price action, to put some rules behind the price movements, and to categorize, let's say, some price behaviors. So, first of all, let's go on Nasdaq like a while ago here. Yeah. Let's do, so I will use, it's the end of 2023, and I'll use it's a random date, the replay like here, okay? And you will see why here. So let's do the beginning of June, July. Okay, and so as how can we determine bias? Well, bias, first of all, the definition of bias is a price is going up, it's a bullish bias, it's going down, a bullish bias, but not price in general. I like to think of bias in relation to a specific candle. So I want to develop a monthly bias if I want to trade a monthly candle, a weekly bias if I want to trade a weekly candle. Otherwise, if the weekly is not clear, my objective is to develop a daily bias, because I trade the daily range. Generally, it's all I do. Rarely I trade 4-hour candles, and in that case it's an intraday or session bias. So it's okay, but think always in this perspective. Give you a time frame to think. So in this case, let's do the monthly bias. And if we start down there, there are specific reasons why price is going up. So first of all, we are coming from a downtrending market. As you know, we are disrespecting bullish PDRAs. We are closing to first the opening price of this order block, then the mean threshold of the order block, and in this lesson I will talk a lot because it's the best way to me to explain. Note down the thing I'm saying about PDRAs, because then I will make it more obvious, but this is the key to bias. Paired up with the CRT, it's the key to understanding where the market is going to, because as I said, the PDRA is a tool to internalize price action. So in this case, we are disrespecting this bullish order block, and if order flow is bullish, we should see some support here. We didn't, so our mind flipped to bearish until proven otherwise. As you see, beautiful flip of the mean threshold of the order block. Because why? Because this becomes a breaker once we close below here, and the mean threshold of the breaker is always respected. Why? Breaker high, low, higher high, lower low, paired up with this. And that's the reason, by the way, why this FVG isn't filled, because as you know, breaker leaves gap unfilled. So another thing to think about. And in this the market is now bearish, and we expect bullish candle to provide a support and bearish candle to break bullish candle. So bullish candle, close below, this becomes support, long wick, so the wicks are gap, it's like an inversion gap, 50% of the wick is a key level, higher time frame PDRA, hold high, turtle super. So we are coming off of this downtrending market, and we are now in a range market. As I said on market profile, the market moves in trend, range, trend, range, trend, range. So right now we are ranging, and what happened? Price attacked range low into, I don't know if there is a PRA on the left, but I suppose into, let's see, yeah, into a higher time frame PDRA, 3 months in this case, just below the range, see? Here, beautiful respect of the FVG, and if you noticed the classic 3 candle model, candle 1, candle 2, candle 3, it's all the same, and I skip in a random point in time, so I'm making this stuff up right now. And now we probe the flow with the same logic. We're coming off with a downtrend, we smack into a higher time frame PD array, and I suppose it is in a discount of this leg. Let me see, I think yes. Premium and discount, remember, yeah. We tap in a discount of the leg, OT precisely, into an higher time frame PD array, and we are now driving up, classic range low, range high, with additional confirmation, because if market is still bearish, we should respect this monthly order block, and we close above the opening, and we still respecting the main threshold, so it's a warning sign. That's why range low 50% and of the range and potentially reversed. And so now we want to monitor price. We close here, we close above the candle that stabbed into the low, this candle, close above. We close above also this order block, respect of the order block, and we close above this thick up close candle that caused, what is this? A breaker. So now the monthly is screaming bullish, and the target is the range high here. That's how you frame a bias, and in this case I want to frame the monthly bias, just to know. So let's remove this straight. Okay, so what's the bias for the next month? Well, after a classic, and this is a thing I want you to drill in your head this thing. After a classic buy sell candle, if and only if it reached a drawn liquidity, not the final draw, but a liquidity pool of some kind, a gap, what is this? If a classic buy sell candle, an expansion candle, reach a draw, you will expect consolidation, and it will happen all the time. So in this case, what happened? We reach this rejection block, and it is a form of liquidity pool. So now the month closes above the rejection block, and so the target is the 50% of the week, but in this case we can be safe that price will reach the range high due to this range low to range high. So the draw is this. Now we expect a consolidation candle, so a doji. If you don't know what a doji is this. Oh no. Okay. A doji is this candle. So long wick, small body. If the body was down there, in this case it is a pin bar rejection. This candle, basically. But in this case we expect a doji, a consolidation, and so we get through the month. We tapped into the breaker, the month closes, and look, we get a small body candle and a pin bar. So another confirmation that price want to go up. Now, only now, the bias for the next month is not only bullish like in this, but a classic buy candle. Because we tapped higher time frame PD array, we get expansion, consolidation, and now we expect another expansion to bring us to the final draw. There is also, there is also just above the range. This is you, okay? This is also above the range, this monthly order block, to keep in mind. And now, next candle, what do we want to do? The bias is bullish. So, this is precisely what happened. A classic bias candle, like this one, by the way. See, small body, expansion, small body, expansion. Here, it's a consolidating, not clear direction. And so, this is how you frame a bias. I will come back in this specific candle in the next lesson. So just after this one today, to spoke about your time, specific time, and how to frame the power of three of a candle. I will come so you have a complete understanding of this. Now let's so I will leave all the drawings like this. Yeah, beautiful. Flip of the opening price. Beautiful. And I don't know, we can go to euro, and yeah, I can I can break down a trade that I actually took. So this, I took this live, this weekly candle. So what I saw at the time. So what I was seeing was this. Ignore this huge monthly candle, but I was looking at this intermediate term high on the monthly, and also the range high on the weekly chart. See, it's a range low, tapped, full swing, range high. So this was my drawn liquidity, and I want to reiterate, this is a trade I took. This weekly candle, what did this do? So thick weekly candle, just below there is this weekly FAG paired up with a previous volume imbalance just below. And if you want to say also the completion of this CRT, Romeo talked about this, candle low, candle high, week above, we reach candle low into another time frame PDRA, but what the draw is still bullish, and the market, we are disrespecting bearish PDRAs and respecting and creating new bullish PDRAs. So after I get this weekly candle that rejected the weekly FVG and close above this down close candle, now to me this becomes our this becomes a order block, a weak order block, and the next candle, as you know, small body, big body expansion. I was expecting a small candle, and that's what happened. But to go more deeply, so sorry, okay, a small body candle. No, sorry, my drawn liquidity was the monthly here. The monthly rejection block is true. It's true. The monthly rejection block, and I was expecting a small body candle. What happened? Well, go to the daily. Monday opened up and attacked the range high, rejecting it. A lot of people sold up there, and I told you about this on Telegram. You said to me, why didn't you sold? And I said, I expect this not to be the high of the month. Then I was wrong on selling here, but it is what it is. I'm speaking about this trade idea. So Monday open up a large doji. Then Tuesday, I was expecting Tuesday to be the low of the week. However, Tuesday printed a inside bar. Wednesday did the same, and so in this case, there are only one option. Either it is a consolidation week or it is a consolidation reversal. So the low of the week should be formed on Tuesday, classic ICT weekly profiles. And in fact, the low of the week was formed on Tuesday. I entered here. I will break this down, same on the next lesson regarding time. I entered in the week, and Wednesday provide a small range day. Now, and Friday, sorry. Now, why did I hold? Because if a weekly candle, let's come back to the week, tapped into a small body, first of all, a small body leads to an expansion to the drawn liquidity. Then, I wasn't expecting a second touch of this key level, and this is there are advanced stuff that you will develop with the time and chart time experience. So, in this case, seeing also the lower time frames, I was expecting a consolidation, small manipulation, and go up from there. So, next week, precisely what happened, and I tweeted about this, candle with no wicks. Look, straight to the target. See? In this candle, you can't buy below the open because open and price fly, and I can't anticipate this every single time, but in this occasion I anticipate, and this is the trade breakdown of why. Now, let's go over some PDR race intricacies. So, close this. So, first of all, and by the way, just a gift, this is the draw for euro. 99.9% I'm sure euro will reach up to this. Maybe now we will get a consolidation week, potentially. Maybe, I said, because we took out a major liquidity pools, but the final draw is this. So you can't consider long-term bearishness until this is taken. And the reason why is this. This is another way you frame bias, and it, in the right context, it always works. You already know how to do this, so I don't spend time. But you should blend PDR rays with a specific candle. And 3 months, I'm not using this as a random time frame. It's a quarter candle. And Romeo anticipated this rally, and I didn't. I was distracted because of this. Candle 1, candle 2, manipulation, candle 3, classic buy sell. Same on pound. Same. See? That's the reason why. So now, let's speak about some PDR ray intricacies. So, the PDR rays are well, fair value gap that can become an inversion gap, as you know, order block, breaker, the one I use. Also, there is a mitigation block. It's a confluence to me, mitigation block. It's a confluence to me. I mainly, the most powerful PDRs are breaker, order block, fair value gap, wicks, because wicks, long wick are gaps, and so the consequent encroachment is a sensitive point. Then rejection block, and sorry, but okay, wick is after, obviously, rejection block, and finally all the highs and lows. that usually, as you know, wicks are liquidity pool, all rejection block are liquidity pool, all highs and lows are liquidity pool, and same for fair value gap. Order block, breaker, mitigation block are specific, and also there is specific price level, also there is mitigation block and more rare vacuum block. If you attended the core content, you know what a vacuum block is. So the key thing to understand is, as you know, that breaker, mitigation block, vacuum block, and order block are specific candles that in a bullish trend or buy program, bearish candle support price, and in a downtrend, bullish candle resist price. Now, the sensitive point of a thick order block, let's do thing well, so up close, candle, okay, so the sensitive areas of a bullish and your reverse for a bearish are the opening price in a thick order block, the opening price, the 50% of the candle, of the body, because that's where the most volume resides of the body, and the rejection block only if price can wick through to the rejection block, only if there is a longer wick below. But generally you should see price remaining in this sorry, a moment. You should see price remaining in this area to the from the wick to the 50%. If price close below, and this is important on a higher time frame, if price close below the opening price, it's reasonable to expect it to reach the 50%. So in a monthly, if you see a monthly order block and a monthly candle close below the opening price, go down to the 4-hour chart and trade down to the 50%. If it close below the 50%, then trade down to the rejection block, because probably the order block won't be respected. If a price close below the 50%, then the order block is invalidated and probably the trend is changed, shorter or long term, as I showed you before on Nasdaq. Then, intricacies of fair value gap, the same. This is a fair value gap, and the sensitive area are the high of a bullish fair value gap or a low of a bearish fair value gap, because let's take a bearish fair value gap as an example. When price, this is high on a lower time frame, this is a lower time frame turtle soup, and that's why a sensitive area. Usually, if price wanna dig deep into the inefficiencies, the 50% is the level, and there is an example, BTC 3-month chart. 50% provide the reaction to go lower. Usually, if price close above 50% on a fair value gap, you can allow it to respect the low with the body. And so there are 3 levels on a fair value gap. Order blocks are more sensitive, usually. Now, breaker, obviously, mitigation block I already talked about. If, let's take this an example. So, shit, okay. Clone. Intricacies of okay, this is a bullish rejection block. Now, as I said, rejection block, you know what they are. If there are any type of long wick below, you expect a rejection block because wicks are inefficiencies. So the key level is the rejection block itself, and if a body closes below a rejection block, it becomes another block. So body should never close below this. This should be a very sensitive level. Usually wicks can reach the 50% of the wick, and that's another key level. A wick is a gap, and so the 50% of a long wick is a key level. And another tip that there is an example on euro. Now I will show you. Also I will show you a vacuum block on euro that I used to trade a weekly range. Usually the candle, and CRT comes in hand, the candle before the rejection block will get taken. This lower time frame liquidity pool will get taken, and the body with a wick maybe. So this is a key level, and potentially the body will close above the rejection block while the wick will take this lower time frame liquidity pool. So let's remove, and I will show you this on euro monthly chart. I know because I traded this. No, sorry, 3 months where it was, well, before price closes, my target, no, maybe GU, it was GU, no, euro, before don't remember where it was. Nasdaq, okay. Yeah, recent price action. Yeah, because I traded this on IS. Okay, not euro. Yeah, I remember. So, see, this is an example. Nasdaq, so S&P 500, yes, respected the monthly, not the opening price, but the key level to me was the mean threshold of the order block. Why? Because it was, there is always a why, because it was below this lower time frame liquidity pool. The opening price was above, so it's reasonable to see opening price and medium threshold. While Nasdaq rejected reached, because it's weaker, reached the rejection block and took the small candle, the small wick before the long wick. And this is a cheat code to turtle soup. If there is a small wick and a long wick in a rejection block, this is a sniper entry. And go back test this. If you have the wrong bias, you always touch, second touch, full swing, go up. Okay, and now I show you this is on you, I'm sure, the vacuum block. There we go. Vacuum block, so order block with a liquidity void / volume imbalance in front. In this case, this volume imbalance is a new week opening up. And I traded this to trade the weekly range. My weekly target was this same thing, rejection block on the daily, small wick. My target was this week precisely. And so I 3 candle model, Monday, Tuesday, Monday range, Wednesday deliver precise. See the precision, see how price rejected this, then continue higher. But look, I exit here at this level with a limit order, obviously. So frame bias, market profile, and blend it with CRT and PDRA to get precision. The only thing it's missing now is time. The time aspect, time the ranges, power of 3, and I will explain all I know, and well, I try, all I use, so you can become the best trader you can be. Also, forgot, this is post-production, but forgot to talk about breakers. So, you know what a breaker is. A high, a low, and once you close above the thick up-close candle that closed the turtle soup, this specific candle, the closing price of a thick candle, if it's thick, if it has a long wick, you take the high, but in this case the closing price is the breaker, and you don't want to see price close below, in this case the closing price. As I said in my recent tweet, that's an indication that a breaker will deliver to the target. So breaker work. However, and that's the logic, an hourly chart is only bullish, so you have breaker as a last entry, turtle soup, entry 1. So an example of a trade idea, you have turtle soup at an higher time frame PDRA on the left, there is one, entry 1 turtle soup, entry 2 the thick up close candle that stabbed into the low. So we bring this forward, okay, plus an FVG. Oh shit, what is this? Every time. Okay. So entry 1, turtle soup at an higher time frame PDRA, entry 2, another block, model 1, so the block plus FVG, entry 3, so we have also another order block here, mitigation block or breaker on the lower time frames, look, 1, higher high, lower low, higher high, breaker, same, and the breaker on the bigger scale, thick candle that caused the turtle soup, because this is a lower time frame turtle soup, so that's why it worked. Here, straight entry number 3, straight deliver to the target. However, once we got up there, we drop. Why? Because the hourly chart was bullish until a higher time frame PDRA is met. A daily order block, the candle that stabbed the eye. So the higher time frame is bullish, but this is a valid counter trend trade idea until, and this is where CRT comes in hand, until the 50% of this candle. 50% daily key level, and so the lower time frame is bullish until it's not. So this is the most anticipated lesson, the one on time, and consequently my approach. So it's also the following up, the perfect following up to the previous lesson, the one on bias and PDR race, because once you have determined the candle that you want to trade, you have determined the most likely direction and shape of that candle. Then you want to drop to the lower time frame to witness the power of 3 and to enter, possibly at the low of that candle, to write it down if bullish, or to the high of that candle to write it down if bearish. So I'm on Nasdaq because, as I said, I want to break down first this candle, then I will break down a weekly and better, and then a daily. Then if you want, I can break down also for our candle, if you want, but my suggestion is to stay on the daily, weekly, and when you are more advanced, you can trade even the monthly range. But my suggestion is stay on the daily and weekly range, anticipate those, learn to anticipate those in a good manner, in a precise manner, to anticipate a classic sell or buy candle and participate only on those, and you can make an entire career of those. So come to the juice. We were here, as I said, the bias, let's remove. The bias for the next candle is a classic buy. We can't go down because there is this monthly order block blocking our way. After an expansion that has reached our first target, this rejection block, we witness a consolidation, a doji candle, so that's good. And now nothing can stop a thick, bulky green candle to the target. Now we range high, and as you know, price can only reverse at a higher time frame PD array. So without higher time frame PD array, let's say so 3 months, there is nothing until this 3 month order block. But let's stay safe. What is, you can target the high itself, or what is just above this propulsion block, monthly propulsion block, because it's built inside another block, this consecutively up close and also break. So it's a propulsion block, and price is very likely to, well, sure to reach this, very likely to reach this, and then we want to see what it does. It can reverse in the 3 month block, or it can go higher. Now, with the benefit of hindsight, we know that it's gone higher, but in this case, let's frame the idea as in that moment. If you can't see the future, you try to guess it. So my target is target 1, target 2. We put a vertical line on the beginning of the new month. Let's do like this, yeah, and a vertical line at the end of the new month. Now, I like to view the monthly range within a 4 hour, with a 4 hour time frame, because it gives me a nice view. See, this is the previous month. Chop consolidation, chop consolidation, chop consolidation. Expansion, consolidation, expansion. So, as you know, the 3-step to high probability trading is gems, this, this is basically my approach. So plan direct time frame key level. Once you have the bias, mark the manipulation time, mark a pre-manipulation swing high or low liquidity pool. So I will break this down. Come on. Okay, so we have developed the bias for the next monthly candle. We have marked the opening time and the closing time. That's the manipulation time. Well, there is a discussion, but use the opening time and also mark the closing, because you should know when to exit. There is a specific time. It's just interesting, huh? So now for the monthly range, I wanna use weekly. Well, you should use a higher time frame key level. Higher time frame in relation to what, you should ask? Well, in relation to the time frame you use to witness the power of 3 of the candle. So if we want to see the monthly candle through the 4-hour time frame and our entry is a 4-hour total super, then we need a key level that we think, and with experience it will get easier and easier and easier, but the key level that is for sure higher than that time frame, so higher than 4 hours. We can see the weekly. Well, what we have, a reasonable key level, not go to this order block. Price can't go this low because of the monthly breaker, remember. So a reasonable key level is a tap into this weekly rejection block, because there are key level. Then if you go down to the daily, there is what you see. Well, I see a range, an FVG below. Let's mark this down. An FVG below, range, turtle soup, and rally. Close above with this candle, close above this daily candle. That's another block. So to refine, well, if price is likely to tap the weekly rejection block, probably it will also tap the daily order block. I mean, why not? So this, I choose this as my key level for the month. And if I want to trade a monthly candle, I do absolutely nothing until price reach this. I wait, I wait, I wait, I wait, I wait. Oh no, this is the bottom. I wait, boom. Now I can consider. So this is the pre-manipulation liquidity pool, and this is my approach. Turtle soup. Then you can go down to the daily, refining the entry. To the 15 minute, 5 minutes, you can go crazy with that. But if you stick to this, your entry here, your stop loss should be on, as you know, I explained to you in the past. So entry at least at the key level, maybe a bit lower, but let's do this. Stop loss at an intermediate term low, this one. Price shouldn't go down until this. These are some inefficiency, but there is no way. This is a rebalance area, so I use this low as my stop loss. You can go safe and use this one, but the risk reward is shit, so I will use this. My target is this, and potentially the monthly order block, because price is very likely to reach that. Then you do nothing until price reach the key level. Then you do nothing again. You wait for the monthly range to develop. For the weekly, you get to the weekly, daily to the daily. You wait. So you took, I don't know, 80% of at target number 1, and you let the 20% reach this, because sometimes you can go wrong. As in my weekly range trade on GU, you remember, I took the majority off at a lower target than the one expected. And that's why I get precise entry with exit. So I anticipated a classic buy monthly candle and I trade it, see, power of 3. And now, so the important time aspect is the open, high, low and close. And that's the main thing you should focus on. Now there is this is the true essence of CRT. The fact that candles are both time, listen closely. Candles are both time and price ranges. Everybody see the price range of a candle. So they see, I don't know, okay, this a price range from this level 13,949.25 to this close above, target this, but they don't see the time aspect. So what are the components? I will take off this and just stick with this. What are the components to a monthly? So sorry, you understand, but let's make the chart cleaner. So let's take only this target. What are the components to a monthly candle? Wicks. The monthly candle is composed by week 1, this, week 2, week 3, and week 4. Now, week 1 and week 2 mark the low or high of the candle, while week 3 and week 4 mark the opposing end of the candle. Always. So, go down to the 4 hour. Let's conclude the monthly range. Stop right here. This is the new month. Okay. So, look at this. CRT. Week 1. Friday until there. Then week 2, and these are time ranges, not price range. Week 2, week 3, and finally week 4 until there. Then the new week start, but the month actually close there, so you can consider this part of week 4 if you wish. I won't, because this is a new week, CRT, week 1, week 2, 50%, and then I guess this is what happened. No? Okay, but you get the point. So, a monthly candle is composed by this candle, this 4 weekly candle. Now, week 2 is usually the manipulation, week 3 is the distribution, and week 4 is the top of the range. In this case, I said week 1 or 2 creates the low or high. How do you understand which one creates? The one that smacks into the level. So, well, obviously, if this smacks into the level on the end of Friday, it's likely that the week 2 will sweep candle 1 high and go above. But in this case, candle 1 creates the low and then go up from there. You can then go crazy. I don't know, but I will. Okay, see? This is a weekly candle. It's composed by, let's remove this, this, and this. A weekly candle is composed by 5 days. 1, 2, 3, 4, 5. Now, I will break down a weekly range trade, but Monday, Tuesday, Wednesday creates an opposing end of the range, in this case Monday, while Tuesday, Friday cap the weekly range, and you know that. Tuesday creates the low. This was a consolidation reversal profile. If I go down to an hourly chart, consolidation, reversal profile. So, let's make this transparent and this black. This is the weekly candle from 17, right? No, 16, 18, okay, so to there. And inside this, there is Wednesday range, and this is how you use CRT. So Wednesday, 18, to look, oh, 18, here. This is Wednesday low, then Tuesday, no, sorry, this is, yeah, Wednesday low, then Tuesday open, go down, Tuesday sweep a time range. This is a price range, see? Price low, soup. This is a time range. Tuesday sweep, and Wednesday is a classic daily candle because of the weekly profile. Consolidation, Tuesday reversal, Wednesday, look, if I go down to the 15 minute, Wednesday is a classic. You have your opening price, classic buy candle. All of this, this is why when you can refine your entry, because you have your monthly key level, you put an alert on, price hits there, you watch the weekly, you can watch then the daily, and you can refine it. Model 1, candle that stabbed into the low, close above, enter there, stop there, and you refine your entry to trade the monthly range. I done that only 2 times, and it feels amazing because your risk to reward will look something like this. That's how I get some of my weekly entries. Stop, as I said, below this, and you get almost 1 to 40 risk to reward. It's not crazy. I know it's tacky to use the RR tool, but I explain to you the logic. So the monthly is, and I can, if I remember correctly, this month, by the way, is another example of week 1 is low of the month, by the way. But if I remember correctly, there is one example on Bitcoin this month. No, on gold. Yeah, there. So I will do another monthly example, and finally, so now there we go. You have a higher, longer bias, so range low to range high, range low to range high. Tap. Bias is still up. We tap this rejection block. We are this rejection block. We are disrespecting this bearish shorter block while creating this bullish shorter block. So now this is a key level. Bias for next month is obviously up from there. This candle meet this rejection block. However, it wasn't. It was only the beginning of the expansion. We are coming off a huge consolidation there, so it's reasonable. Another not huge. I'm not expecting this month to deliver to this. It can happen if there is manual intervention, but a tradable candle should, and then the next month should be the actual expansion. As I said, big body, small body, big body. Now, I don't remember what happened, but yeah, tradable candle, and then huge, no, rejection, okay, okay. But same logic. So this is, if I remember correctly, week 2 low of the month. This monthly order block is also a weekly breaker. See the fractality? So weekly breaker block, thick candle that goes the turtle soup at an average time frame pretty array, close above, breaker, weekly. We have also an FVG pair with that, so with all that knowledge, we want to refine the key level and we choose this as my monthly key level. For hour, do nothing until price reaches the key level. Nothing, unless you want to trade like a daily range or weekly range within it, it's okay, but to trade a monthly, do nothing. But you got a beautiful pre-manipulation liquidity pool, 4-hour turtle soup, and then do nothing again and let the monthly range play out. Then you can, once, obviously you need to be smart, once we close above the high that broke the low and we use the breaker, the 50% look, the 50% of the breaker tapped there to rally higher, and we break above this high too, move the stop to break even, or even to this low. And there we go. So now we have start on Tuesday. Okay, I will incorporate this. So Friday, Tuesday, Friday, Sunday. Okay, so week 1, I incorporated 2 days from week 2, for the week of the previous month. Week 2, if you don't want, it's like this. If you don't want, but it's the same. Well, let's do the series. So it's this. Week 1, week 2, and then week 3 distribution. 3 candle model. To the high, candle 1 accumulation, candle 2 manipulation, and I say that because below this below this range, turtle soup rally, look at the retest of the previous low. There is another range, I think. It's always like that. Yeah. So below the higher time frame range, we tap the key level, and we form another range at the end of the candle. And week 2, sweep, as I said before, if candle 2 creates tap the key level at the end, the very end of the candle, it's likely that the next will soup this. If not, and like on Tuesday reversal, then the low is formed on week 1. In this case, 2 turtle soup of the low and it is a Monday low of the week. Why? Why this week is a classic buy week, but with Monday low of the week, not Tuesday? Because we were already at a key level. Monday creates the low because the price had no needs to manipulate more. It has already manipulated and remanipulated this time range. Now rally. That's why you need to keep in mind also the monthly development, the weekly development, if you trade the daily, for example, because it's all nested together. Time. So now let's break for you down a weekly range trade on Nasdaq, a week that trade that I took on the early days on Twitter. You can find the post and is one of the first posts. It was this one, same logic, boom. So Monday, okay, week, we were, well, breaking highs, rejecting lows. It's a clear bullish market. We got this, and this is around the time that Romeo told me about CRT. Before it was made publicly, it added me in the chats group some days after this trade. No, some days before, and he hinted at me, and this was one of the first real trade that I took. A beautiful sensation. So we were in a clear bullish market. Down close candle are providing support to rally higher. We have a down close week, the second week of the month, and the bias for the next week is still up. Why? Because we have closed above this candle. False breakout reached the CRT low there. No, not yet reached, but okay, so this is a reasonable intraday target, maybe for the Asia session. Okay, but the bias for next week is probably up, probably. Then, so these are target for a daily range trade, a beautiful one, a weekly CRT, so you can skip it. Okay, we are in a bullish market, however, so every dip below a low, and this was the catalyst for price higher, because range, every dip below a low is to be bought, at least until proven otherwise. Also, I remember, okay, we're already above all-time high. So, week beginning, we mark the weekly open, we mark the weekly close, okay, and then a key level. We know that the price is likely, very likely, to go below these relatively equal lows. What is under these lows that can send price higher? Well, there is this, and I want to reiterate, I took this trade, my entry was down there, up there. So we took this order block because the opening price was never tapped, and it's just below this liquidity pool. So to me, this is my weekly key level. I make this liquidity pool lighter, and I like to view the weekly candle within the 1 hour time frame to see how clean this low looks. Price is likely to drop below this into this key level. Do nothing until price reaches the key level. And I remember this was a Wednesday low of the week. I remember this. Same logic. There we go. Pre-manipulation liquidity pool. Also, if you wanna see Monday, 13, Tuesday, Monday it was shorter. I remember why, because this was a bank holiday day, so part of the day was taken. Yeah. Monday, mega accumulation. Tuesday, Wednesday sweep. Well, let's Wednesday play out, and you do nothing, and you let the weekly range play out. Wednesday, manipulation, and Tuesday you don't even get the chance to buy below the open, because price open, look, open, and fly. and I took even this one, also remember this, top of the range on Wednesday, 3 candle model, 1, 2, and potentially to the 50% of Tuesday. So same thing, and I guess if I go on to the 5 minute below the range, there is a range. Yeah, so this is the low, and below this range there is another range, another soup, and if I can't go to the 1 minute, right? No, unavailable. Okay, there I guess there is a 1 minute range and another range. I don't get involved in this. This trade was taken exactly, I can say it because I take this, so remove, 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 remove. Tuesday never tapped the key level, so I was expecting this a soup, and I didn't enter there, even though a lot of people were trapped because we were below the equal lows, but the key level wasn't tapped yet. So my entry was market here just before NFP. This is NFP, this thick candle, sorry, FOMC. So my entry was almost there, and my stop was below this down, no, on the what I said, no, this was one of the instances where there isn't an intermediate term low. I use a 1 to 3. I explained this, a blind 1 to 2, sorry, of the range that is souped. 1 to 2 is a good measurement to the key level. I 1 to 2. My stop was around my entry was a bit higher, like this, if I remember correctly. You can reverse engineer the trade, it is on my Twitter, but almost like this, a blind 1 to 2 of the range that is souped, and that's it. And I hold without any partial until there. This was my first partial at Monday high, look at this highs, and then final target up there. Weekly range trade, almost in one candle. The end of Wednesday and Tuesday hit the target. So weekly range in 2 days. Same on the trade I broke down to you on JU. Always the same. So if you are asking me, and nobody's talking about this because people are ignorant and stupid, the way I get my precise entry are time, open or and close of a candle that I choose to trade. Important, not a random one. A candle that I develop a bias. I choose to trade that candle. I mark the open and close. I profile the candle, and within that I use the candle that makes up the higher time frame candle to know which CRT to play. In this case, it was, look, CRT, you enter in candle number 2 all the time. Yeah, because of this. This is the secret. Tuesday, key level of the week. Wednesday, entry there. 3 candle, classic buy. You are positioned already before this, but you are entering in a high probability, higher time frame candle. This case, the weekly. This case, Wednesday low of the week is a pin bar. But because of FOMC, it looks like a classic buy, almost. But the reasoning behind was CRT, low didn't tap, relative equal. I search for a higher time frame in relation to the hourly chart, PDR is below, to put one extremities of the week, and the other was this all-time high at the time, liquidity pool. So you enter there and you are done here. Same, now I break down a daily range trade, if I remember one that I took recently. So daily range, well, the one on yes, my last post on Twitter was like this, and it's the same thing, this one. And by the way, I close it precisely here. Yeah. So it was so precise, this trade, amazing. And you know why this high? Because it's the high that broke the low, not market profile, basic of market profile. The high that broke the low. Now, it can go down and reach to the breaker itself, because this candle wasn't touched, so it can go down and reach to the breaker, and in this case we will witness maybe a potential buy opportunity from the breaker to the all-time high, or it can directly go up from there, more likely, maybe. But break down this trade. So well, daily bias, because weekly I can't get a weekly bias because the week is already at the hand. So monthly is already beginning. So the only thing, if I'm trading, is trading a daily range. I can't play the monthly anymore, it's gone, and I wanna enter the low or non-entry for me. So monthly gone, weekly gone, it rests the daily. What day is it? What day of the week is it? Well, it's Wednesday, and tomorrow the day I want to trade is Tuesday. So Tuesday usually cap the weekly range, and in this case, if and only if the week has reached its weekly objective. So in this case, we got Monday, Tuesday, don't close, Wednesday, and Monday itself reached above this liquidity pool, and this liquidity pool, in fact, after this classic buy candle, Tuesday was a small range, consolidating. Wednesday, a relatively small range candle to take Tuesday high, and so I expect Tuesday to cap this weekly range, digging into this daily FVG and what's inside the daily FVG, this old high, not any random high, the high that broke the low. This was the birth of a trade idea, so previous day high, CRT if you want, but I took out 80% at Wednesday low and 20% to this second target. The higher time frame key level was this daily order block. Yeah, exactly this daily order block. It was, well, let's be precise, it's a bit off. Okay, this daily order block, so we mark out the opening of the candle we are willing to trade, the closing. Then I like to play the daily, looking at on the 15 minute, we have Wednesday high and Wednesday low. Okay, and so I want to sell above the open if I'm bearish. I do nothing until my key level is reached. I do nothing, I don't care, I may be wrong, or this might just be a consolidation. I wait, okay. There, press reach the key level. This was the primary relation liquidity pool, in this case, range turtle soup, down there. I didn't take partial at 50% because it was very, very likely to go down there, and let the daily range played out. Boom, classic sell candle. Obviously on indices, the high of the day is very likely to form a New York. in relation to London, because London is an inactive time for US indices. So now the big question, what did compose the daily candle? Answer, as Romeo said, 4-hour candles. And by the way, even on inches is 159, not 2, 6, 10, 14, this shit. No, it's 17, the open. Only a 3-hour candle because the futures market, the indices and the commodities opens 1 hour late, 1 hour after. So, but 17 candle, 9, 1, 5, 9, the most active on indices. 1 AM is good on Forex. 13, 1 PM and 5 PM, closing of the day. So you have CRT, candle 1 and candle 2 straight to the target. Same thing. So 15 minutes. Now high opening. You have timed range. So you have 1 to 9. 5 to 9. You have 9 to 1. This candle is 1 hour less for the reason I pointed you out. 1 to 5. And you can trade these alone. However, they are very inactive. As you see, 1 and 9 are the most high probability. Then you have 5 to 9, the 5 AM candle, and finally a soup of the time range CRT, a soup of the 5 AM candle by the 9 AM. So then this is how you can verify your daily entry, 9 AM open, sell above the open of this candle. And you can trade this by itself. But why, if you can frame out the daily range, right? Open, rally, enter at the key level, and I did this on the 15 minute. So you understand this? Now remove. As soon as price hits my key level, I execute market. My invalidation was just above, because to the 62, if I remember correctly, because the price is unlikely, is already at a deep premium at the right time, so it's unlikely to go over. My target was Wednesday low, 80%. Higher broke the low, the remaining 20%. And from this higher time frame PDRA, the market turned. Look. Let's go to the 30 minute, also the hourly. The market turned on itself until, so perfect entry and perfect exit. I hope I clarify my approach and the mysterious time, and let me know if you have any answer. I will try to answer them on the private chat on Telegram. I hope you will have a good rest of your weekend, and see you in the last. Hi, so this is the final lesson, the one on my models, and first of all I want to do an introduction. So these are not models that are used by themselves. You can. My suggestion is building your approach on this. You can choose a few that you like, 1, that you particularly resonates with and build your approach on it like I did. So my approach is more structured, but the foundation and most of the time my entries are based on these models. Then, second point, these are all time-based models, so they are not price patterns like a simple market structure shift with a free value gap. They are not like this. They are time-based specific models, and now that I will explain this, I will also talk about like a little the narrative that you want to find, the bias, the general context in which these models works best. The only one that isn't time-based model is model number 2, the last one, and you will see why. But it's easy to blend it with time. Some of these models are fractal, some of these are specific to one time frame, and some of these also work best in Forex, and others are universal to all markets, and I'll explain why regarding to every models. Then, last thing, this will be mostly by my choice a theoretical lesson, so I will draw just so you can understand the basics of the model, the why, and then my suggestion and homework, if you wish so, is to go back in time into your charts and see this model by yourself. Do screenshot of them, of the one you like, obviously. Do screenshot, keep it in a journal, in your computer, your phone, whatever you want, and look at that by yourself. If you want, you can send me also some photo and I will comment that. But if you see this logic in price action and you resonate with it, then you need to view it, to find in price action the model by yourself, because that's the way you learned. So I will show you a schematic logic and also speaking about in which condition the model works best, and then the work of finding it in price action is to you. So let's begin. So the first basic one, this is also another one I forgot to say, not time-based, but it's easy, and I will tell you why. It's easy to blend it with time of the candle you are trading. So the first model is a classic range model, and probably you already know that, but I will touch a bit on some gems about this. So let's assume you have a clear and defined range. Okay, so you have a range defined clearly where price is not breaking this. Now you have what? A range high, a range low, and an equilibrium price points. And an equilibrium. And the way I already told you this, to verify the equilibrium, it's seeing the respect of price, of this price level. And so you have these three not subjective price points, a range high, a range low, and an equilibrium. Now, this model is a controller model, so you are engaging price exclusively at the high, the low, and the equilibrium. Yes, the equilibrium too, because one type of entry is price manipulates down into the range low, you buy this with a clear invalidation, and invalidation can be either an intermediate term low, in this case to the left, you wait for a change in state of delivery, or you go to the blind entry. Either way, you buy the range low, partial 50% of the left at the 50% of the range, usually witness a retracement, and then you take price to the other portion, the other end of the range. Easy. So that's the main entry of this model. Obviously, reverse in a sell case, and there are clear rules. Range, enter in the total soup, partial at 50%, partial on the other way. I use that sometimes when there are clear ranging market profiles. Then I'm mostly interested in buying or selling at the range extremes. Obviously, if there is a monthly range, okay, like many monthly candles that are in a range, then I can trade the lower time frames like the daily, weekly easily. So it depends on what you're trading, but the logic is this. Then the second type of entry, and this is far more advanced, is both, and this is the gem, is both for false breakout, so the beginning of the Judas that led to the turtle soup, or for if you are bullish and you are expecting price to be bullish, but you are not witnessing a bullish turtle soup of the range low, you can enter for the true breakout of the range. This is a little more advanced, but it's the same. So usually at 50%, you will witness a turtle soup at the 50% of a previous liquidity pool, and the true breakout with the retest of the range high. So in this case, case number one, turtle soup to the 50% and the opposing end. Case number two is entry at 50% more advanced if you are expecting a true breakout, and target range high and potentially beyond. Second entry or pyramid, you can pyramid at the retest of the range high. You can find example. I traded one on Ethereum of this. Finally, at the 50%, fairly advanced entry is turtle soup at 50% to bring us to an extremity, and if you're bullish, this is the turtle soup that will lead to the breakout. So this is an entry if you are able to anticipate this with ideally a key level above, okay? So this can be a weekly candle, a daily candle, open, rally. This is how you blend this with time. Open, rally from the open, higher time frame, key level. Judas, remember, you want to say this taken to then go up. So you are done by this low of the week. If this is like Tuesday, Monday, Tuesday low of the week, enter to the weekly expansion. But so there are two, you can engage price only at range low, 50% and range high, either as a retest, as a turtle soup, as a false movement. So this is model number one with the clear and defined rules, and obviously you can use, if you choose that this is the only thing you trade, obviously there won't be as many setups, because you need to wait for a ranging market profile to happen. So you miss on the expansion phase. But that's a model sometimes I use. Then the other one more that gives you more setups, not every week, but most of the week, is the classic Monday range model. So we have monthly candle. Okay, so well, let's do like this. So completely, okay, you have monthly candle. Let me say this. Okay, so you have monthly candle bullish. Let's assume you have a week. Okay, you have a monthly candle, then you have, so sorry, Monday candle, then we have Tuesday, and these are all models that I use, remember. Then you have Tuesday, and then finally Wednesday. And this is also connected to another model that I will explain. So the Monday range model is a three candle model of a specific time frame, and okay, basically it's, you have Monday low and high, and 50% of the Monday is a specific type of the range trading model. It's not the same, because the range trading model is a actual range that builds up liquidity. This is a candle range. It's different. So you have a Monday low, Monday high, and you take, obviously with context, otherwise it will be a pattern. So with context, you will take Monday from low to high directly, and this is how you trade partially the weekly range expansion, because for this model, and that's what everybody doesn't talk about. Romeo said this, but taking it with a low profile, so not everybody understand. To trade this model, it's not the same as a range model, because that's based on market profile. This is based on weekly candle power of 3. So you basically you are basically trying to, and that's one of my this is one of my favorite model. You are basically trying to catch a portion of the weekly expansion. And what's the beauty about that? That if the weekly candle is open Monday, this is Monday, then Tuesday, then Wednesday to the Monday high, then you're down, you're done by this. But you may be wrong, and this is not a expansion candle, but it's a doji. So maybe after taking out Monday high, price will reverse for Tuesday, and then Wednesday, Friday, small range day. But the model is the same. So Tuesday, it's or Wednesday, ideally Tuesday. So ideally Wednesday reach Monday high, and usually Tuesday it's a higher time frame PDRA and the reverse. Okay, so you trade like from here turtle soup to here Monday range high, and you're taking the movement into a doji candle. So the candle will look something like this, and you are still able to trade this weekly candle. That's the beauty. I made a mess. One moment. Okay. So taking in mind this, on the lower time frames, it will look something like this. So Monday creates a range, an expansion, then closes maybe here. Okay. Tuesday opens, usually it's a doji, so go down, smack into higher time frame key level and closes near the open. Then Wednesday, drop down from midnight opening price and then rally expanding to Monday high and finally closes. So how you trade this model? You can, if you have, first of all, you need to develop a weekly bias, a weekly clear direction, and if you can anticipate either the shape of the weekly candle is best. So how do you anticipate the shape? Well, after an expansion, consolidation is needed, and also keeping in mind the time, so the time aspect, so which week of the month it is. As you know, usually the first and fourth week of the month are low range, small range weekly candle. So you anticipate, you will develop a weekly bias, a weekly expectation. Then you drop down to the daily. You ideally find a key level here. In this case, Tuesday should create the low of the week for the model to be valid, and you can enter either in Tuesday low, so the turtle soup, so the low of the week, you can enter here. You can enter directly with an invalidation on the left. You can wait for your pattern to develop here below the opening price of the day, end of the weekly candle. Or you can wait, let candle number 2, so Tuesday develop, and wait for Wednesday to distribute, and potentially sometimes even Tuesday, to distribute price, so enter just below the open, to Monday high. So that's the type of entry you can do. Candle number 2, my favorite, or candle number 3 below the opening, or phases of reaccumulation within the distribution. Okay. Now, why didn't I say take partial at Monday 50%? I never do that simply because I want to. Now, Romeo throw this model on Twitter and on his private mentorship without context. So Monday taking 250% and high. Now, I never take partial at 50% because I do not trade pattern. I want to have a clear expectation for the weekly candle. If I don't have an idea, a directional idea for the weekly candle, I don't trade this. If I know that the weekly chart is trending higher, potentially towards a higher time frame liquidity pool, this week I'm bullish, then I can confidently buy with a defined risk Tuesday soup and hold until Monday high, reversed from bearish case scenario. So you understand, it's a different approach. The first step is the weekly bias for this model, and then you trade this. Then we coming to the same logic but fractal. So if you wish to have more trade frequency, you can do this instead of the Monday range model. You can trade the Asian range model. So same thing. Now, there isn't a specific candle for the Asian range model, but I said it in the past. You also remember the and sorry, one last thing. For the Monday range model, if the expansion for the weekly candle is up, usually Monday high is retested and it becomes a key level. Also, you see order block, so that's why order block retested, go up. I said that because it's the same thing from the Asian range, and you saw me actually executing on the retest of the Asian range. So the Asian range model is like this. Asia is from 20 to midnight. So let's do like this. So if you do a screenshot, you have all the info. So it's from 20 fuck it. Okay, so Asia is from 20 to midnight. Why? Because most of the time, if you go back in your chart, you'll see a spike in volatility at 20, so 8 p.m. New York time. So that's the Asian session, and I say Asian range because this work, obviously, I wanna say the Monday range model is universal to all markets. The Asian range model is for Forex and especially, always, only for Western currency like the euro, euro dollar, pound dollar, USD CAD. Why? Because if you trade US like USD JPY, usually the Asian session is really active because it's a JPY. Same for USD NZD, AUD USD. They are like very active in that session because in that part of the world, yeah, you understand. So if the Asian session is an expansion, then you don't trade this model. You wanna see some kind of range to form. So that's why it works best on Forex because London is active, and especially on euro, pound, CAD, Canadian dollar, and all of this. So you wanna see a Asian from a low high. So you take what? You take the higher low and the lower high, the higher high and the lower low, sorry, in this period of time, and that's become your Asian range. Now you can extend it and do whatever you want, but how do you trade this model? It's a pattern? No, because now there is the Asian range pattern. If you can find it online, it's not an ICT concept, or it's a pattern historically known. So one side to the other side. That pattern was back tested, and the results are like just above like 51-52% of win rate with a 10 pip stop loss. Why? Because every single pattern without logic and context lead to nothing, to break even. With a 1-to-1 was the test. How do I trade this? Same thing for the Monday range model. I need to have a clear directional bias and for the daily candle. So if I'm expecting the daily candle to deliver to the upside and be bullish, I come to the charts at almost at 7 usually, my time, so it's 1 a.m. But I trade after midnight. This model happens only if I see a clear and defined Asian range, more or so. It shouldn't be perfect. It can be also like this, but not a straight expansion. So I come to the charts, and if I'm bullish on the daily range, I wait for what? A purge of the Asian low and then a distribution to the other side, potentially using the Asian high later on as a support level. So that's how I do it. And you saw, if you scroll back in my Twitter feed, you will saw that my entry on Euro, I missed the soup because I was at sleep, and I come to the charts around 6, and at 6 a.m. my entry was on the retest of the Asian range. So that's the model. Obviously, if you are bullish for the daily candle, you wait for a purge, and like there is I back tested it in the past, like 1 year ago, there is like 81% of probability that London, if it is a classic buy daily candle, will purge Asian low. If it is a classic sell, 81% that it will purge Asian high in London. Ideally at 3 a.m. It can be between 1 and 4. The ideal time is between 1 and 4 a.m. So you can trade in this model. What are your entries? Same thing. Enter in the soup itself, my favorite, and not the third. Or wait for the retest of the Asian high. Now, same thing inverted. So if you are bearish for the day, you wait for a purge of Asia high above midnight opening price. So same thing above midnight, a purge of Asia high, and you bring this to the other side of the Asia range. Your model can be just this. So you will be done from here to here. Your model can be also, and that's what I said, you can build upon this. You can be also, this is your entry for the high of the day, in this case. You take a partial at the Asia low, and you hold until London close for Forex, until towards the end of the daily candle. You can trade like this, so this can be your model. I'm just giving you ideas. In that trade, I enter here and I hold for the daily close. So it's another approach. So this is the Asian range model. So I have explained the classic range model, the Monday range model, the Asian range model. Now it is a bit different. It's the next day's model. And I want to give credit to this for the name, at least, because now our trade this model is different. But for the name, I take the name by the MMX trader. However, my approach is not only different but extremely more refined, because the knowledge of time is on another level. So same thing for this model is. In some cases, like the Monday range model, but it does not have the same rules. So, and it's more versatile. It's a logic here, and that's spoiler. That's how I trade daily ranges. Okay, I use this model to trade daily ranges. Otherwise, I do not participate in them. So, for this model, you need to wait. First of all, develop a weekly bias, weekly expectation, so weekly directional bias, and same thing. Once you have developed that, you stick to that and you wait for the high or low of the week to form. So if you are bullish on the weekly candle, let's say, this is Sunday open, okay? You wait for you skip Monday, you wait, you ideally mark off a daily key level, because usually it's what will mark out the low high of the day. So in this case, you are bullish for the wheel candle, okay? You are aiming at a drawn liquidity above or whatever. You mark a daily key level, so the block, FVG, volume imbalance, breaker, whatever you want. You wait for price to hit the key level and to form the low or high of the week, and you let the day closes, okay? So let's say this is Monday, and this is Tuesday. You wait for Tuesday to close. So the low of the week is already put in at a higher time frame key level in line with your expectation. Then what do? You trade the next day, so Wednesday, and it is an incredibly high probability of being a high low of the day. Not only Wednesday, pay attention, the day after the low of the week is formed. And I say that I show you later. So in this case, Monday, Tuesday, Wednesday is a classic sell, and you trade this day. So same thing, you can use Asian range model to enter. It's fractal, so midnight open, buy below at ideally total support level, whatever you want, and you trade this day because it will be, with an extremely high probability, a classic buy day. Now, why I said that not Wednesday, but the day after the low or high of the week is formed? Because if you are familiar, and you should be, with the weekly profiles, I use 4 of them. So the weekly profile I know and use and I see repeating over and over again are the following. Fuck your shorts or long inversed. So Monday low and keep running towards the week. You have an example on GU some weeks ago. Then we have classic buy, so Monday, Tuesday, Thursday, okay? Then you have a mid-week reversal, so drop from the open, Wednesday hit a key level and reverse. And then finally you have a consolidation, Tuesday reversal. So consolidation throughout the week, Tuesday drop, taking out the range low into a key level, and Friday is a classic buy. Now, you need to be familiar with these weekly profiles. Why? Because in every instances, you will have some days available to trade with this model. So, in fuck your shorts, you wait for Monday, you skip Monday, you see that Monday was already at a key level and formed the higher low of the week. Then you trade Tuesday, Wednesday, and Thursday as classic buy. Example, some weeks ago on GU. Classic buy sell profile. You wait Monday, Tuesday hit the key level, you wait for the candle to close and confirm. You trade Wednesday as a classic buy, not Thursday, because it will be the cap. So only Wednesday in this occasion. Midweek reversal. You wait, Wednesday hit the key level. This week, past week on EU, clear example, and I called it live on Twitter. So you wait for Wednesday to hit the key level, form the low of the week, Wednesday close. You trade Tuesday as a classic buy. Only this. In the last case, you skip all the days until Tuesday created the high low of the week, closes, and you trade Friday as a classic buy. All reversed from bearish cases. So now write notes of this, because you will know which trades, which days to take a trade, a potential trade. So time before price. So if the week opens, wrong tool. If the week opens on Wednesday, drop down, Wednesday creates the low of the week, like in last week on EU. You wait Wednesday to close, and you trade what? Tuesday as a classic buy candle. Then in the last week on EU, Friday was a chop. So you are trading the highest probability day regarding the weekly profiles that unfolds in this week. So you develop a weekly bias, you mark a key level, you try to understand which weekly profile is unfolding, and then you trade the highest probability day/days of that week. Usually is only one. Usually, unless it's a straight line toward the week. In that case, there are like 2 days you can trade, like a classic buy-sell candle, daily candle. That's one of my favorite approach to trade the daily range, and I trade only the daily range after the higher low of the week is formed. So I use all this model, not by themselves, but together. Next, we have the 1 AM model, and this is one of my friend's model. So I'm not inventing it, it's Villa. I don't know if you know Just Villa on Twitter. He is one of the best of my student from the beginning of 2023. And he trades only, exclusively 1 AM candle of one asset, GBP, JPY. Now, the 1 AM candle, you can trade it on which pair do you want. I don't suggest indices, because obviously they are more active towards the New York session, but on Forex it works perfectly. So 1 AM model, what does it mean? Well, usually it works hand in hand with the Asia. So if you have a clear expectation for the daily candle, then look for Asia low or rise. It will be easy. You can trade this model even if you don't have a clear bias for the day. You should only develop a bias for the session, so for the 4-hour 1 AM candle. So is this candle more likely to expand higher towards a 1-hour FEG, something towards Asia high, towards that liquidity pool, is more likely to expand downwards? Then, so creating the bias for the 1 AM candle, you have 1 AM opening time, 1 AM closing time, so 5 AM, and then you treat the candle watching its profile. So if the candle opens, consolidate a bit, and drops into a key level, like a 15-minute FEG, because it's a 4-hour candle, a 15-minute FEG, 1 hour order block, something like this, on which time 1:30, then it will be a classic buy sell, a classic buy. So on which time 1:30, okay, not random, this is 1:30. If instead it reaches your key level, your anticipated higher time frame key level, at the midpoint in time of the candle, it will be a pin bar, and the midpoint of between 1 and 5 is 3 AM. So your entries should be always within this model at 2 times, either near 130 or near 3. Otherwise, it will be a choppy candle, so avoid trading it. Just a suggestion, if you don't trust me, go see yourself. The highest probability 1 AM candle forms the low either at 130 or 3. After this, so this is one model, you choose one specific candle and you trade only that. You are content and you close the trade at the end of the candle. So you are entering at the low and you are closing near the end duration. Another model is the 9 AM, and it's the same exact model, the same. So you have ideally classic buy, sell, and so reach the key level. What did I do? At in this case classic buy sell, because it reaches your anticipated higher time frame level at what time? 9:30. So it's the 9 AM candle, 9 to 13, and the key level, if it reaches around 9:30, it's a classic buy sell. Otherwise it will be reached towards the 11, because it's the midpoint in time of the, it's ugly, destroying, it's really ugly. Okay, better. So if it reaches the key level at the midpoint in time, 11 o'clock, then it will be a pin bar. Every other times it's low probability. And I said why not the 5 AM candle model? Because the 1 and 9 are the highest probability candles to trade, for our candles to trade. 1 because it's London, and 9 because it's New York session. Now, with the 9 AM model, you can trade it on Forex, like Euro USD, GBP USD are very likely. Or if you are really getting pip drunk and catching crazy moves, indices for this model usually offer like a crazy expansion. And if you become really good to anticipate with this model, you can catch crazy moves, because usually the 9 AM candle on indices, on S&P 500, Nasdaq, forms 80% of the daily range. So if you enter with a 5-minute stop loss and at 9:30 usually, or 11, and target the entire daily range within a 9 AM candle, one trade a week can retire you. Finally, we have a generic model, so a model that works on every time frame you want to trade: monthly candle, weekly candle, daily candle, 4-hour candle, 1-hour candle, and it's a model that Romel spoke about. And his intent, he chatted with me and others on the chat group, and his intent was to spoon-fed as much as he can people, because on Secrets of Time he didn't give a 1, 2, 3 model, a simple model for the lazy ones, for the dumb people. So he did it on UTS. He decided to create what? Model number 1 plus. And the plus is for the not so dumb people. Model number 1 only is for the dumbest people I know. Because it's, I mean, if you trade only this, yeah, like you have a 60% win rate, maybe. With a 1-to-1, I'm saying. Because if you are to increase without context your RR, then you're fucked. But model number 1 plus is it acknowledges also time, and so if you use it like I'm told, like I'm telling you now, then you are likely to succeed, and this can become your entry model because it is an entry model rather. So it works within every candle, model number 1 plus. So choose a candle you want to trade. Anticipate your that candle bias, so the most likely direction and shape of that candle. Once you have that, so let's say you want to trade a monthly candle. You are bullish for that monthly candle. You wait for without time-based ranges, without projection, without it's really simple. So monthly opening time. If you are bullish for this month, you are waiting for a drop below an old low. So let's draw it like this. You are waiting for not necessarily before the opening time, so I will do both cases. You're waiting for a drop below an old low, close above. So a drop below an old low using this, the candle on the 4-hour time frame. On the time frame you are trading the candle, so monthly 4 hour. On the 4-hour time frame you are waiting for that specific candle that stabbed into the low to be closed above, and that becomes your model 1. Why is model 1 plus? Because you are incorporating the aspect of time to trade a specific candle. Okay. Now, obviously, and I explained this to you, if you blend time-based ranges, if you blend higher time frame key levels, if you blend time of week, so day of week, time of day, higher time frame context, and all of this, then your win rate will increase massively. But if you want to keep it extremely simple, then are you bullish or bearish for the next candle? Okay, bullish. Then I'm waiting for opening time, a drop below the opening price of the candle I'm trading, a stab into the low, a close above the candle that stabbed into a previous low, and rally. Now, this, and that's what I was saying, the low can be also after the opening time, so it can be like this, so open, creating a low, a stab into the low, and then rally. And this is then your model 1. Okay. Reverse all of this if you are bearish, obviously. So same thing, the low can be also, and this for the monthly candle can be like week 1, week 2, but keeping extremely simple, it's bullish, buy below the open at your order block, so model 1. Bearish for the candle you are willing to trade, sell above the open after the model 1, so the candle that stabbed into a previous low above the opening price and close below is created. That can be a really simple model and a working model, because if you focus on the bias for the higher time frame candle, and then you are looking essentially for a lower time frame pattern below or above the opening price, it's a great model, in my opinion. If you trade it like this, because you implement logic and narrative to this. Finally, an amazing model that is not necessarily time-based, but you can blend it with time easily, and that is not spoken a lot. Romeo said that, and it's great in my opinion, and it's really easy. It blends EARL to EARL concepts with the turtle soup, and you can add the time like the range, the classic range model. So essentially is fuck it. Okay, so essentially it's one moment. I'm drawing the key to this model, the key PTR race. Okay, so a higher time frames gap is a lower time frame turtle soup, and that's model number 2. Scroll back to the Twitter feed and you'll see this. So higher time frame gap, fair value gap, is a lower time frame liquidity pool, and so a lower time frame turtle soup. So essentially on the lower time frame you will see this. So well, let's making this little above, and on the lower time frame you will see like a rolling, something like this, and then something like this. So a lower time frame gaps, a higher time frame gap, and this is the gap view on the lower time frames. Okay, is a lower time frame turtle soup. So you blend in this case pre-manipulation liquidity pool with the higher time frame key level in one, and you are trading this with a lower time frame risk to higher time frame reward. So essentially what you are doing, and this trade by the way is the exact model that Romeo uses 2 days ago on GU. The last trade he posted where he said CRT is this model. So it was a daily bearish fair value gap on GU. The day it was a Wednesday pre-CPI, London of Wednesday, smack into that bearish daily FVG. It sold there and it sold there and waited for the daily range to develop. So it's a model that occurs more often than you think. You can use a daily gap with a daily candle. So daily gap, you trade a daily candle. The same gap you traded, that's how you blend it with time. You traded the same candle, time frame candle. So in this case, you will trade, I messed up. So in this case, you will have traded the, let's do like this. The daily candle, if it was a daily gap, the monthly candle, if it was a monthly gap, the weekly candle for a weekly gap, and there is an example on Euro, the last bearish run of the last year weekly gap, beautiful weekly delivery. Daily gap, beautiful daily delivery. 4-hour gap, beautiful 4-hour delivery. So you already, in this case, in this model, it's easy because you already know which key level you're looking for. It's not subjective, it's that one. The liquidity pool, it's the liquidity of the gap. And so you are essentially breaking down this candle. So the opening time of the candle you're trading, if it is a daily midnight with a daily gap, drop below, you enter here, okay, with a stop either at an intermediate term high or low on the left that you trust, or you wait for a lower time frame change in state of delivery, or you go with a blind stop like I do sometimes. So you enter here at the gap and you can target obviously the high that broke the low, or wait for the, like I do always, for the range of the candle to play out. So in this case, look higher time frame view, lower time frame view. This is model number 2, also very simple and effective, I would say. Maybe if you're trading daily gaps, so daily candle, you have one trade per week, and you can increase that by having a basket of asset. So maybe yes, NAS, Euro, GBP, so pound dollar, USD CAD, you can have a basket. This can be just your model. You trade daily FVG for the daily range, and you will find that you will have a crazy win rate, because a same time frame key level will have will produce high probability swings on the lower time frame that is used to see that candle time frame. So in this case, daily key level, 15-minute high probability swing. Weekly key level, 1 hour high probability swing. Monthly key level, 4-hour high probability swing. So with this, I conclude the lesson, and now you understand why I didn't show you example of every model, because the lesson would have been like 2 hours. So it was a long one, but and the final one. So I hope you enjoy, and let me know if you have questions or everything. And once you figure out your model / approach, I would also love to know what is, so just for curiosity. I mean, you started knowing nothing or knowing a little, and I hope that with this journey your trading, your knowledge of the charts have improved. And if you come to the conclusion that you want to trade in a specific way, some specific time frames, waiting for something specific to happen, I would love to know what it is, just for curiosity. So wishing you a good rest of the weekend, and see you. Here we are. So I'll try to condense everything in this video, but I will share with you also some clips from Romeo contents, and some pre-chosen clips that you will watch afterwards. And I hope not to confuse you in your methodology, in what you're doing every day, but my goal is to explain to you a system, an approach, the approach that I use, and the approach that should be the foundation to every trade you will take from now on. The one Romeo's use, the one I use, and the thing I keep in mind every time I look at the chart. So, first of all, I want you to know that price fluctuations are designed to fuck you. So you need to watch at price at a chart like smart money did. So through times and price levels. That's it. Time and price. Not pattern, not FEG, not small candle closure on the lower time frames. The one thing you want to be concerned of are the higher time frames and the logic that I want to explain you right now. Everything else is noise. So once you identify a key level and a timestamp where you want to do the business on, you take the trade, you risk what you want to risk, keeping in mind that you can lose it, no matter how much probable the trades look, and then you simply let the market do what it wants to do. You can't control price. The only thing you can control are your action. And your action should be preparing for the trade, analyzing the chart at your best, and then let price do what it wants to do. And you need to think in the long term, in the long run, because trading is a game of probability. No matter how good you are, no matter how good your edge is, you will still lose. With experience, with time, you will grow, and your ability to identify only better setups will grow with you, but you will still lose money. So after this rant, I want to explain you the system. So I want to first of all explain to you the logic, and Romeo talked about this not very much because it's pretty mind-blowing, but the names that ICT uses: Asia, London, New York, midnight, are session and linked to real-time session in the markets. But the logic behind it, as you know, price is fractal, but also time is fractal, and so the behavior of price built by time and price correlation is fractal. That's why you can trade a monthly candle like you trade a 1 hour candle, like you trade a daily candle. So the system that should be the foundation to all your model is simple. You want to identify the most likely direction of the next higher time frame candle you want to trade. So this is a candle, this is a bullish candle, and sorry, a moment, okay. This is a bullish candle, this is a bullish high time frame candle. It can be a 4 hour candle, a daily, a weekly, a monthly. I personally like to trade the weekly candle and the daily. I'm not, I generally don't trade a 4 hour candle. To me, it's too short of a time period, but you can absolutely do that. And for obvious reason, I avoid trading 1 hour candle power 3 because I don't like to scalp. So this is the higher time frame candle you want to trade. And let's say analyzing the higher time frames, so the time frame, let's say this is a weekly candle. You analyze the weekly chart, you look at the monthly, you zoom in at the daily at maximum, and you frame that the most likely direction on the next weekly candle is bullish, is up. You identify a draw that can be a higher time frame FEG, relatively equal highs, and you want also to trade in line with the higher time frame order flow. So if the weekly order flow, so the institutional, because institutions trade on the weekly, monthly, and daily chart. If the higher time frame order flow is bullish, it's likely, and it's reaching for something, it's likely that the next weekly candle will also reach for the draw on the upside. So you frame the directional higher time frame bias. That's the first step, and that's the most difficult one, but once you identify it with a clear, in a clear manner, 65% of the work is done, because you simply need to trade in that direction. So the system is identify the time frame directional bias, 65% of the work done. If it isn't clear, stay out of the chart. Absolutely don't trade. Then mark if you remember the famous post of Romeo, the ones that he wrote on paper, the steps to high probability trades, it's number one, plan the higher time frame key level. So you plan the higher time frame key level, and it can be an higher time frame PD array, it can be general higher time frame PD array that you think that will mark the low, in this case because you are bullish, of the candle we are trading. So you mark higher time frame key level. If you trade a weekly chart, look on the daily, weekly, and maybe monthly key level, not go below that. You mark the higher time frame key level, plan the higher time frame key level. Step 2, mark the manipulation time. Step 3, mark a pre-manipulation liquidity pool. So now I want to rant over this to explain you the logic. Many people think that manipulation time are the same of opening time of the candle. So in this case, it's a weekly candle. You mark Sunday opening. Yeah, to see the power of 3, you should mark the opening and the closing time. Those are fixed values. But manipulation time are all different beasts. And I'm here for that. Because it's pretty amazing when you realize that. And that's a tweet that made me realize this. 2 tweets actually. So, manipulation times. Every single candle have a manipulation time. Keep in mind an algorithmic way of how a candle is built. So, for the daily, and keep notes of this time. For the monthly candle, no, let's start with the daily. For the daily candle, the manipulation times is known by many. It's midnight New York time, 0000. That's the manipulation time, and the icttrading cycle that ICT teaches start not from 17 to 17. So the chart opening time of the daily candle and closing, but start from midnight New York to 17. That's the true day. And before that, that's Asia. So price open here, trade like this. That's Asia session. Then at midnight, it creates a Judah swing down. Then London creates the low of the day, 70% of the time. Then rally up. You will get out in New York, smacking into the Asian range, and a rally higher. And at the end of the day, you will get the cap of the daily range. So let's remove. So the daily opening time is here, this dashed line, and the daily closing time is here, 17 New York time, 5 p.m. and 5 p.m. The manipulation time is midnight, and everybody knows that. So people, ICT said buy below midnight opening price, because from midnight onwards you want to see a Judas. ICT also said mark the Asian range from sorry a moment, from 8 p.m. to midnight Asian range. You want to see one extremity taken and then use it as that's the Asian range model. This schematic is fractal to all candles, and that's the system. So let's say this is a weekly candle. You have the opening of the week on Sunday, the closing of the week on Friday, okay? And the manipulation time is Tuesday opening time. So Tuesday at 5 p.m. If you go to the daily chart and put a vertical line on Tuesday, it will be on 5 p.m. The actual opening of the day. So from this line to this line, this is Monday range. Sorry a moment. Okay. Let's turn this up. Okay. So from this line to this line, that's Monday range. Monday range. And that's the Monday range model. So same thing, opening on Sunday, Monday trades. It will not be a consolidation like this every single time, but Monday trades. Tuesday open, Tuesday midnight will be here, more or so. So Tuesday open at 5 p.m. That's the manipulation time of the weekly candle. Tuesday creates the low of the week 70% of the time. Wednesday is a classic buy candle. Tuesday creates the opposing half of the range at a higher time frame PDRA, and Wednesday is generally in a classic buy candle, a small range day. Let's go to a monthly candle. So monthly open here at the first of the month, monthly close here, the month close here at the last day of the month. So you have week 1, week 2, week 3, week 4. The manipulation time is the open of week 2. Week 1 is, and that's what Romeo said when he made, sorry a moment, I want to paste a photo. So gems here, this one. So look at this image that Romeo shared. Swing trading down right. Week 1, spend time with your family. So avoid week 1. Week 2, look for the higher time frame key level to it. Turtle soup. Week 3, look for the opposing higher time frame key level to it, and so mark the high of the month in a bullish month. And week 4, so week 3, you close the trade. Week 4, go for a walk in the park. That's generally. And you can say, yeah, but I saw some month that the week 1 creates the low of the month in a bullish month. I saw some week that Monday creates the low of the week in a bullish week. I saw some day that Asia creates the low of the day. Yeah, that's true. But, and this is my rules, you can, with experience, anticipate that. But I have a rule. Skip Asia. Trade London. If you miss London, trade New York. And that's not relative to the daily candle only. Skip Asia means skip Asian session in a daily candle. Skip Monday in a weekly candle. Skip week 1 in a monthly candle. Obviously, skip week 1 if you are swing trading, so trading the monthly range. If I want to trade the weekly range, I trade week 1 as a weekly range trade. You understand? If I want to trade the daily range, I trade Monday as a choppy day, but I trade Monday. If I want to trade the weekly range, I skip Monday. So skip the Asia of the candle you are trading. London, so it's the London session for the daily range. It's Tuesday for the weekly range, is week 2 for the monthly range. New York is 7, it depends because sometime in a daily candle, the retracement, the time that gives you the OT is like the 5 AM candle, sometimes it's 7 to 10, sometimes it's the 9 AM candle, so it depends on the daily candle because it's highly affected by intraday volatility. But let's say New York session, on the weekly candle, New York is Wednesday, on the monthly candle, New York is week 3, and week 3/week 4 creates the high of the month. What's about a 4-hour candle? So let's say this is a 4-hour candle. You have the open, let's say it's the 1 AM candle. So you have the open at 1 AM. Let's make this bigger and horizontal. Oh, sorry, center. Okay. You have the open at 1 AM. Or let's do like this, middle. Okay, you have the open at 1 AM. You have the closing at, this is 14, okay. You have the closing at 5 AM of the 1 AM candle. Middle, horizontal, center. You have the manipulation time at 1:40. And I need to find the post, but I will share with you. Now, maybe I can paste it too. So here. Oh, okay. So let's only show you this here. This. Look at this post from Romeo. It's a 1 minute chart of USD, and what is highlighted here? 130. I'm not inventing this stuff. So 140 is the manipulation. So if you're trading a 4-hour candle, you skip the first half an hour. You wait for a Judas at 140, or if it's the 9 a.m. candle, 9:40, not random time, 9:40. You see? So it's a time-based trading, and the ICT names and the names that I like to use are the first portion that you want to skip before the manipulation time is Asia. So let's do like this. It's Asia. No, sorry. Background. Okay, Asia. Then the manipulation time is midnight. It's the name that I like to use because obviously midnight I refer as midnight as manipulation time. Week 1 for a monthly candle, I call it Asia. Week 2 open, I call it midnight of the monthly candle. You understand? So midnight. Week 2, Tuesday, London session, I call it London of the daily candle, of the candle, sorry. And then there is New York of the candle. So New York of the daily is the New York session. New York of the weekly candle is Wednesday. New York of the monthly is week 3. New York of the 4-hour candle is, I never think about it, but will be like 1:30, 2, 3, 3:30, 3:30 onwards in this case. Yeah, because we have the 3 and that's it. Sometimes when New York creates the higher low of the candle, you have the swing creating at 3, the midpoint. So the system is skip Asia, enter for your setup after midnight of the candle, enter in London. If you miss London, wait for the New York OTA. That's it. And one more thing, because I previously mentioned that Asia, so the Asian session, you see some days that the Asian session creates the low of the day, like clear this. So sometimes in every candle, Asia opens, chop around, hits the high, chop around, smack back down into the key level, and create the higher low of the candle. London rallies, small consolidation, manipulation, and then rallies from there. Sometimes this happens. So you have Asian session creating the low of the day. Monday creating the low of the week. Week 1 creating the low of the month. I never train the monthly range, but I'm saying to make you understand. You have in the 1 a.m. candle, you have 110 creating the low of the candle. That happens sometimes, but the rules stays the same. So you skip this portion, you enter for your setup after midnight, and if you see that higher time frame key level, that the higher time frame key level is it higher time frame PD array, is it during Asia, and that's the only occasion that Asia creates the higher low of the candle, you will play the true breakout of the Asian range. So true breakout of the Asian session, retest of the range here, retest of the range. No, let's make it red. Yeah, red. You will get the true breakout after midnight of this range, not the soup and then the rally, but the true breakout. And you need to understand this. You need to keep your eyes open for this. So sometimes week 1 of the month create the low into higher time frame PDRA, and week 2 simply break out of the range, and the high of the range becomes a key level. So your trade will be this. In a daily candle, Asia creates the low of the day. You are asleep. Doesn't matter. You wake up, and in London, you look for a retest of the Asian range, a time-based breaker. And I hope you saw my last post on Twitter, not the last post, the last trade I posted. It was this. I missed the soup of London, and I played the time-based breaker, so the retest of the Asian range. In a weekly candle, Mondays creates the low of the week into higher time frame PDRA. You wait for Tuesday to retest to break out. You can enter obviously right here. If you have the skill, you can enter here, and or you can wait for the breakout and then retest, and you enter here. So this is a system, and you simply now need, this is what Romeo do. He skips the first portion of the candle, wait for the manipulation time, and when he says wait for the his system, sorry, is so candle opens, trade, Asian range, smack hardly into the key level, full swing, rally, and this uppers. So when Romeo says in his system, plan the higher time, number 1, plan the higher time frame key level, higher time frame PDRA. Number 2, mark the manipulation time. Number 3, mark a pre-manipulation liquidity pool. Most of the time, the pre-manipulation liquidity pool will be the Asian low. So Asian low, Monday range model. Week 1 low, the low before 130 if you're trading a 4-hour candle, like in this example. So no, not this, but this, like in this example, the high before 130 pre-manipulation liquidity pool, or where it was, and by the way, you were not supposed to see this stuff. There's some pretty powerful thing in here, but I can't find the picture that I want to share. This was the system that I was talking about. Elements of high probability trade setups. Number 1, plan the higher time frame key level. Number 2, mark the manipulation time. Number 3, mark a pre-manipulation swing high low. Number 4, 2 and 1 are more important than 3. Why this? Because if Asia creates the low of the candle, you don't have a pre-manipulation swing high-low, a pre-manipulation liquidity pool. You will play the true breakout of the range. The more important thing are time, manipulation time, and the higher time frame PDRA. Because if you can find the higher time frame PDRA, and you see that Asia or Monday or week 1 or you understand that Asia smacks hardly into the key level and reject it, you have the higher low of the candle right there. And you play the true breakout and the retest of the range. You have a system. If you rewatch this video multiple times, you have a system. And you simply now, it's really, really simple. What you want to do, your job now is find what candle you like to trade. Mine is the weekly and sometimes the daily. I'm not going below it. Villa, I don't know if you know it. Yeah, just Villa. He likes to trade. He trade only 4-hour candle. 1 AM candle is its favorite, and sometimes the 9 AM. So you use the exact same system. But he likes to trade the 4-hour candles. I like to trade the weekly and daily. Maybe someone with less time likes to trade the monthly. For me, it's too less trading. Like you have, I don't know, 8 trades in a year. To me, that's not doable. But yeah, find the types of trading you want to do, and then apply these rules. So, skip Asia, plan the time frame key level, mark the manipulation time, mark a pre-manipulation liquidity pool if the higher time frame key level was not hit on Asia, enter on London of the candle you are trading, and if you miss the actual low of the candle, wait for a retracement in New York, either the retest of the Asian range or I don't know, a retracement into a fair value gap, what you do, and close the trade at an opposing higher time frame PTRA during Tuesday if you're trading the weekly candle, London close / New York close for indices if you're trading the daily candle, week 3 / week 4 if you're trading the monthly, and towards the end of a 4-hour candle if you're trading the 4-hour candle. You have the system. I hope I helped you, and this take me a lot of time to figure that out, but once you truly digest this information and you truly understand what this means, you have no FOMO, you have no fear, and if you blend this with a solid risk management plan, your risk, what you're comfortable losing, and you play the long-term game, it's done. Nothing can stop you. So, I wish you a good rest of the week, and let me know what you think. And right now I will send you this video. Sorry for the long rant, but it's a long one. And I will also send you some Romeo's clip about this